New York City on this Tuesday, November 19th. Welcome to Yahoo Finance's flagship show, The Morning Brief, brought to you by Invesco. I'm Shauna Smith alongside Brad Smith, and let's get you the three things that you need to know today.
Good morning, everyone. First up, geopolitical tensions hit global stocks as investors look to safe haven assets following reports that Ukrainian forces carried out their first strike on a border region in Russia using U.S.-supplied missiles. The yield on 10-year bonds dropped and gold rose amid the news. Earlier, Russian President Vladimir Putin approved an updated nuclear doctrine that expanded the conditions for Russia to use atomic weapons.
Plus, in earnings news, Walmart boosting its outlook amid strong spending from value seekers. Shares of the company are rising as the retailer's average ticket size rose 2.1% from a year ago. This coming amid increased spending from upper-income households. Meanwhile, retailer Lowe's extending its streak of declining sales, a weak housing market weighing on the company. It did, though, lift its sales forecast amid a strength in its pro business.
And a historic crackdown on big tech here. The Department of Justice will ask a judge to force Google parent Alphabet to sell its Chrome browser, according to Bloomberg. The request comes after the judge ruled in August that Google illegally monopolized the search market. Google says the proposals would harm consumers and developers.
Geopolitical tensions rattling investors in the markets this morning. You're looking at a global stocks falling as Vladimir Putin lowering Russia's nuclear response threshold after Ukraine reportedly launched a long-range strike on the country. With us to discuss is Yahoo Finance's Rick Newman. And Rick, you can see clearly serious implications from a variety of perspectives right now, but that, of course, playing out in the markets here this morning.
Right. I think a lot of people have tuned out the Russia-Ukraine war, but it's actually getting more intense and more serious. This is becoming a global conflict. I mean, we now have Iran and North Korea basically allied with Russia, and North Korea recently sent troops to Russia that they can use in this war. And the Biden administration, obviously, they're saying that in response to North Korea sending something like 10,000 troops, they have now finally told Ukraine that, yes, you can use U.S. weapons to strike military targets inside Russia. And of course, the Biden administration only has a couple months left in office. So I guess they want to see if they can make some sort of definitive difference here on behalf of Ukraine. But this is definitely getting more intense and more serious. It's worth pointing out Vladimir Putin, the Russian president, he has made many threats that he has not followed through on, and there's a good chance that this is another one. It's basically an implied threat to use nuclear weapons in this war. But the things that he is threatening are getting increasingly serious. So we just need to remember this is an incredibly serious war that's going on in Europe.
Yeah, nuclear threats, much different than tariff threats. But as we continue to think about what this means amid a transition, Rick, what type of difficulty does that layer on then to not just geopol, but also some of the larger business relationships that are going to be and have been anticipating, of course, what's coming in January and the changing of the guards in D.C.?
I mean, we're almost 3 years now into this war since Russia invaded Ukraine in 2022. And we've been, markets have been through a lot of adjustments here. I mean, there has been a huge adjustment in global energy markets. I mean, I think that's the very first thing that anybody would think about. And everything has settled down in terms of markets. So assuming Vladimir Putin does not actually start to move nuclear weapons around or do something like that, I think markets will shake this off. And we would know, I think the United States and the Biden administration in particular, I think they would be very vocal if they started to notice any signs that Russia might actually be thinking about making good on this threat of using perhaps a small nuclear weapon. I think we'd know about it. I don't think it would come as a surprise. So I think markets will settle down, but this is just a reminder that there are huge risks related to this war. In the meantime, we have this other war going on in the Middle East between Israel and Iran. These trade-offs and missile strikes and stuff like that. So the world is a dangerous place. The Trump administration is going to have to deal with this right away. There's not going to be, let's take 3 months and develop a new strategy, undertake an examination, form a panel, stuff like this. They're going to be facing a messy world right away. So we're going to be dealing with this straight into the new administration.
Rick, thank you. We're keeping tabs on the markets here, going into the start of trade here, of course, on this news. Appreciate it, Rick. Well, traders are buying into safe haven assets this morning amid the ramp up in geopolitical tensions. Gold's rally that resumed, and investors buying into treasuries across the curve. Joining us now for more, we've got Michael O'Rourke, Jones Trading Chief Market Strategist. Michael, thanks so much for taking the time here pre-market. As you're thinking about the geopolitical tensions that are ramping up and ratcheting higher, what does that signal to you in terms of the first trade that you would be making off of reports?
I mean, I like treasuries. I've liked them coming into the election, and I know they were getting sold on President Trump's victory. I think the inflation concerns are a little overblown in the short term, and I think the selling was just overdone there. So then you get an event like this, or the headlines like we've had this morning, and that just reinforces the likelihood that treasuries are going to bounce, pushing yields lower. But at a 4.34% 10-year yield, that's a pretty attractive, safe investment.
Mike, how are you evaluating, or I guess how should investors be evaluating the heightened geopolitical risk?
I mean, I think Rick nailed it here. The investors have been somewhat complacent. As he said, the market's been shaking off, whether it's the events in Ukraine, the war in the Middle East. Investors are just, they're excited about a lot of things. They're excited about the election. Obviously, there's still a lot of work to be done, and a lot of transition has to occur. That just because someone's elected, things don't automatically become policy. So we've seen a lot of euphoria out there that I think it's really going to be hard to sustain once you have to start transforming some of these goals into policy.
What do you think are the top policies that markets are already pricing in, and how is that playing out within your own strategy?
Well, I mean, the main thing is everyone's expecting the government to cut a tremendous amount of spending that's considered waste, and that will help fund the deficit and will help fund tax cuts and also fuel deregulation. So those are all tied together. But in the same respect, it's rarely do we get everything we want, and the devil's in the details. And of course, we really don't have details. But the market is seeing, the glass as more than half full, and that is why there's so much enthusiasm out there. I think going to year end here, investors should be a little more cautious. We've had a tremendous run, tremendous year, and we're pricing in gains that or expectations that really it's going to take time and work to achieve. But on top of that, equities are very expensive here. They're at one of the most expensive points in past 3 decades. So investors, it's a great opportunity for you to be a little more defensive here.
Michael, how does the Fed factor into your expectations here, not only between now and year end, but looking ahead to 2025 and what you think the pace of this cutting cycle maybe more realistically is going to look like?
Well, that's a great point, because the Fed came out in September, gave this very, very dovish outlook on interest rates, expecting to cut, down to about 3.75% by the end of next year. And what we've seen is, relatively strong economic data. And of course, we're going to have a different presidential administration that is going to have entirely different policies. So it's almost, you have to take that forecast and just throw it out at this point. I know Chairman Powell said, things aren't going to change in the short term until policy is enacted. But that said, we know the policies in 2025 will be distinctly different than 2024, and investors should be prepared for the Fed to shift strategy here. Right now, the markets have begun pricing that in. The market sees the Fed funds rate, I think, around 3.8% at the end of next year, about 50 basis points above where the Fed forecast was. So I think the markets are adjusting to that, but it's something investors need to keep an eye on.
Do you see policy throwing off what the Fed has really kind of come to expect right now in their policy pathway, especially as we already know, and as you mentioned a moment ago, $2 trillion in cuts, plus if there were mass deportations, you're talking about potential hits to both elements of the dual mandate that the Fed has really been leaning on in order to go forward with their target right now?
I mean, that's it's a great observation. These are seismic shifts you're talking about from a a policy perspective. And what the Fed is going to have to do is they're going to have to navigate those shifts. So they're going to have to see which way the economy moves with these events. And the question is how much of the events are actually going to be move into policy in 2025, and how much of an effect are they really going to have? So I think what you really have to do is just look at the environment we're in. Thus far, we have a very good economy that's been relatively strong despite a high interest rate environment. The Fed has significantly eased already, and now they just have to wait and see how the policy takes shape and how the president and the administration executes that policy.
All right, Michael O'Rourke, Chief Market Strategist at Jones Trading. Thanks so much for hopping on with us here this morning. Wall Street strategists are out with their S&P 500 outlooks for next year. David Kostin from Goldman Sachs, the latest to announce his target for the benchmark index. He expects the S&P to hit 6,500 by the end of 2025. Joining us now to break it all down, we have our very own Josh Schaefer. And Josh, you've been closely, as you always are, looking into these notes, seeing what strategists are saying. And one of the main takeaways from what you've really been observing, I believe, is the fact that it's not all about AI.
Yeah, so that was something that Goldman also expressed in their note, right? And we wrote about that a little bit in the morning brief newsletter this morning. So Goldman Sachs coming out saying 6,500. That's in line with Morgan Stanley's call for 6,500. BMO, Brian Belsky coming in at 6,700. But when you combine all of these and sort of what they're making an argument for, they're all relatively similar in a continuation of this broadening out of the stock market rally, that it will no longer just be the Magnificent Seven driving this market higher. Of course, this is a trend that's already been happening, guys. We've been talking about that for the second half of this year. But when you take a look at that chart that we're showing on the screen now, Magnificent Seven outperformance compared to the S&P 493. The Magnificent Seven outperformed by 63 percentage points in 2023, 22 percentage points in 2024. Goldman sees them only outperforming by 7 percentage points. That would be the narrowest outperformance we've seen in the last 7 years, essentially saying that if you're going to benchmark maybe that Mag 7, there's opportunity outside of the Mag 7 to find names that are going to succeed. And to me, I think just the broad takeaway also with that, Brad, is for a while it felt like when you read these outlooks, it's hard to explain why the market's going up. It must be AI, right? It must be this AI theme. Now you have a lot of other things. The Fed is in cutting mode. The economy's in good shape. Earnings are expected to grow for the 493. There are a lot of real, tangible things that people would normally cite for why stocks can go up that you can put in your outlook instead of just, I don't know, AI number go up, man.
Yeah, I mean, within the valuations that all of the firms are continuing to monitor and how front-run some of these companies have been compared to their valuations, how far out do you believe that they are looking and trying to make sure that there's still a case for growth into those valuations that have been locked?
Yeah, Brad, so from a broad index perspective, one thing that stuck out to me is there are not a lot of people calling for significant valuation contraction, right? So we talk about the market being expensive, right? Yeah. Perhaps on a forward 12-month price to earnings ratio. Most of these strategists are saying it hangs out around that sort of area. So earnings actually probably grow into the PE in some sense in that way, and that's what pushes your market higher. But I think from a tech perspective, Goldman had an interesting point on this, sort of pointing out maybe we move from the infrastructure AI, that would be your Nvidia, right, the ground floor of AI, to this basket they call enabled revenues.
Enabled revenues.
Enabled revenues. It's phase 2 of AI. There's a long 30 lists of stocks.
I've been waiting for that.
I don't have our 30 lists of stocks in front of me. I remember Snowflake being on there. That wasn't going to be one of the big ones I'm going to name, but Apple and Meta, from a tangible way that we can understand enabled revenues, those are two of the bigger names in that basket, right? So Apple, of course, being a company that could leverage AI to sell products and revenue, but they're not creating necessarily AI in the sense that maybe Nvidia is creating AI chips. Similarly with Meta, maybe they have chips down the line that they're working on, but right now they're using AI to monetize something like Reels, right? So it's going straight back into their revenue. And so a continuation of that in 2025 and what companies on these earnings calls are going to say, we're monetizing AI to help with our revenues is sort of where they see that narrative pushing.
Enabled just means we'll be able to touch it and like actually experience it.
Yeah, I mean Meta AI is real. You go on Instagram Reels, and they are showing you curated products based on what you already looked at, right? That is AI we can understand, AI we can touch.
All the people need to know. All right, Josh, great stuff. Thanks so much. Keep right here on Morning Brief. We are just getting started. We're going to count you down to the opening bell on Wall Street as investors are seeking safety here this morning. Plus, we're sitting down with the CFO of Walmart. He's here to break down those results coming up next. You're looking at gains just about 2% in shares. And we will talk antitrust as the DOJ weighing a historic move against Google's parent company, Alphabet. We got all that and more coming up on Morning Brief.
Welcome back. You're watching the Morning Brief brought to you by Invesco. It's now time for some of today's trending tickers. You can scan that QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. First up here, though, Walmart reporting strong third quarter results, beating Wall Street estimates and raising its full year outlook as shoppers continue to search for value. Joining us now, we've got John David Rainey, who is the Walmart CFO, and our own executive editor, Brian Sazi. John David, great to have you back here on the airwaves with Yahoo Finance. Just walk us through what you're seeing from consumers that are engaging with Walmart.
Sure. Well, it's great to be on the show again. Thank you. First of all, we had a really strong quarter. We grew the top line 6%, and once again grew operating income faster than that at 10% growth. And what's notable about our quarter is the growth in our digital businesses. Our e-commerce business is now 18% of our overall business, and that's up 300 basis points from last year. Customers have always come to Walmart looking for value, but now they're coming to us looking for convenience as well, and we're better serving them in that way.
John David, good to see you here. Every earnings release that you have posted this year, you have called attention to gaining share with upper income households. Let's flip this script. With those households still struggling out there, let's say earning less than $75,000 a year, clearly not upper income, are they trading down on what they're buying when they come to Walmart?
Well, we've been really pleased with the share gains that we've seen across all income cohorts. In this quarter, though, about 75% of those share gains came from households that are making more than $100,000 a year. And I think what's notable about this, Brian, is that we're providing convenience. As I mentioned in my earlier answer, convenience matters to everyone, irrespective of what level of income that you make. And so that's something that people haven't historically thought of Walmart for. We've always been known for low prices and value, but now we can provide a lot of what they want every day to their homes or allow them to come to curbside to pick up those items.
But do you still sense that the consumer in this country is struggling?
The way that I would describe it, Brian, is it's been very consistent. We certainly see that pocketbooks are still stretched. Prices are down if you look on a year-over-year basis, but if you go back prior to the pandemic, food prices are still up probably north of 20%. And so we're providing value for those customers that are having their dollars stretched further. And we see that they're buying less general merchandise. As they're spending more on food, there's less money to go to some of those more discretionary type items.
So John David, it's Sean. It's great to see you. Clearly, from what you're saying, Americans are under a bit of pressure here today. And here we have a new president-elect, Donald Trump, set to take the White House in January. Part of his policies that he's been put forward here, or that he has put forward, are higher tariffs, talking about 60% tariffs on imports from China, 20% from items from other countries. What are the implications for Walmart? Could it force you to raise prices?
Well, look, we've been living under a tariff environment for 7 years, so we're very accustomed to that. I'll remind you that 2/3 of the items that we sell are made, grown, or assembled in the United States. So we're always going to look to work with our suppliers or use our own private brand assortment to try to bring down prices for customers. Everyday low prices is what we stand for, and so we'll have to navigate that environment. Tariffs are inflationary for customers, but we want to work to bring down prices.
John David, one of the most popular stories on Yahoo Finance the past 2 days, it is comments from the CEO of AutoZone, of course, another retailer, they sell auto parts. He said flat out, if tariffs are coming, we're going to raise prices in advance of those tariffs. Philosophically, do you share that view at Walmart?
Well, look, as I said, Brian, we want lower prices for our customers and members. We advocate for them for lower prices and value, and so we will do everything that we can to not raise prices. But we also, right now, this is speculation. We don't know what categories of items could, or even what countries tariffs could apply to. We are familiar with this, and if we look back historically, when tariffs were enacted 7 years ago, it did result in higher prices for customers.
John David, when we think about the luxury consumer that we were acknowledging earlier in the conversation, and it's clear that there are more luxury consumers that might be trading into Walmart right now, what are the investments that you're making as you're talking about that within the earnings release to retain that luxury consumer? I mean, especially for those out there that may have seen you guys partner with companies like StockX to bring more of the kind of the swag bag into the offering as well with Walmart.
Yeah, well, first, let me say I appreciate the way that you characterize that, trading into Walmart versus trading down. We don't think of it as trading down. We provide a lot of value for our customers, but I think it really goes to the importance of convenience. And let me give you an example. So of the items that customers buy that are delivered from a store, fully 30% of those items, customers are willing to pay something more for to have it delivered within 1 hour or within 3 hours. And so speed is a big element of this, and we're providing that very well. And that's something that we are uniquely suited to do, given that we have 5,000 stores in the United States that are located within 10 miles of 90% of America.
How do you explain, John David, some of these online sales gains? This has continued throughout the year. I mean, over 20% growth in every single division. Is it more than just expanding the number of items that you're selling on the site?
I think it's assortment. That's the first point, as you mentioned, but it is also convenience. We, as we're giving people more options to buy things that they haven't historically thought of Walmart for. We talked about this on the call. Historically, we've not been very successful and had our fair share in things like apparel. Someone would want to go to another store to buy those items. With our marketplace business, we can provide third-party merchandise to allow customers to have that broader assortment. And if you just focus on our marketplace business, in the third quarter, it grew 42%. There are categories like home, hard lines, toys that all grew north of 20% in the face of a general merchandise environment that is relatively flat to modestly growing. So it shows you that more eyeballs are coming to our website, more customers are converting those journeys, those shopping journeys into a purchase, and we're able to deliver it to them within their expectations.
John David, you certainly are able to outperform in this environment. When it comes to the holiday season, of course, you and your competitors are facing a shortened holiday season. Do you fear that at all is going to pressure sales here in the fourth quarter?
Well, it's always interesting when you get to this year where you have 5 fewer shopping days between Thanksgiving and Christmas. And I'll tell you, internally, it creates a lot of noise. We look at daily sales reports, and the comparisons year over year are challenging sometimes. But I don't think there's going to be less toys underneath the tree for kids simply because we have a few less shopping days between Thanksgiving and Christmas or the other holidays in December. And so we're looking forward to the holiday season, starting with Thanksgiving. Thanksgiving is coming next week, and we're eager to offer a basket of 29 items for our customers. They're actually 3% less than they were last year. And so we'll build on that as we go into the December holiday period and look forward to providing everything that our customers want.
Is the holiday season off to a good start?
It's off to, I would say it's off to a good start, in line with our expectations. It's day to day. Some days are a little behind our expectations. Other days are a little bit better. But overall, it's in line with our expectations. And look, our sales guidance for the fourth quarter was 3 to 4% up. So that's a pretty good indication of how we're thinking about the holiday season overall.
All right, John David Rainey, thanks so much, as always, for taking the time to join us here this morning, CFO of Walmart. And, of course, our thanks to Brian Sozzi as well.
Thank you.
Let's get to another ticker that we're watching here today, and that is Super Micro filing a compliance plan to avoid being delisted from the NASDAQ, saying that it is on track to submit delayed filings to the SEC. The company also hiring a new auditor, BDO, after EY resigned as its accountant last month. So we're seeing a bit of a relief play out in the market here this morning. The stock up just about 26% here ahead of the open. I do want to point out shares are still off just over 80% from the peak that we hit since March. So we still have a ways to go if we're looking to get anywhere close to that level that we had seen just a few short months ago. But again, the latest reporting here of Supermicro's plan is accepted by the exchange's new deadline for the documents, likely going to be pushed into 2025, into February. It will be able to stay listed on the NASDAQ until a final decision about its compliance until that has been made. So again, you're seeing a bit of a relief here in the pre-market this morning, Brad.
Yeah, it's going to come back to what BDO and what the accounting and the deep work that's going to need to be done there to make sure that it's in compliance, and then ultimately bring those financial statements current. It's really just going to come back to that at the end of the day. And the submission of that, as you mentioned, really being pushed out to this point. Some of the dates that we're looking at here, they're looking to hopefully be able to complete their annual report on Form 10K for the year ended June 30th and bring that current within the next few months here, and seems like early next year. So we'll see if they're able to do so.
All right, keep it right here on Yahoo Finance. We got much more of your market action ahead. We'll be right back with the opening bell.
Welcome back, everyone. You're taking a look at the opening bell here at the New York Stock Exchange. You've got GMO ringing the opening bell, and then on your screen as well, you've got the NASDAQ, where the good folks at Vico are ringing the opening bell. And, of course, there you hear that bell ringing. All right. Let's take a look at things. You're watching the Morning Brief, brought to you by Invesco. Let's take a look at the markets here. The U.S. major averages right now, as we see the opening cross, the Dow Jones Industrial Average, you are seeing that to the downside right now. By about 0.7%, we begin the day. The S&P 500, you're seeing that just barely to the downside here by about 0.5% as well. Let's populate some of these charts for you here, and we'll come back to the NASDAQ here as you're taking a look at the heat map for the NASDAQ 100. A lot of red on the screen to begin the day's activity. Nvidia, one of the bright spots, though, that's up by about 0.8%. Of course, big earnings report coming this week. Let's take a look at some of the sector activity as well here to begin the day. Yikes. All right, we're not going to linger on this sea of red for too long, but taking a look at XLY, do they have an alibi? As of right now, no. It's down by about 1%. And then Staples, hey, that's catching a bid. Of course, a lot of this activity really coming off of some of the heightened geopolitical tensions that we have seen. You're seeing a little bit of a flight towards Staples right now. That is the lone gainer right now among the S&P 500 sectors. It's up fractionally by about 0.3%, but a lot of red, about 10 out of 11 sectors in negative territory as of right now. For much more and a read in on some of the early trade, let's get to Yahoo Finance's Jared Blickry for a look at what's moving. Hey, Jared.
Well, hey, Brad. I want to go back to the S&P 500. I'm going to put a 3-month chart on the Wi-Fi Interactive behind me, and we are just violating, to a very small degree, the election breakout level. That was the breakout level, 2 new highs in the S&P 500, and this was actually, there's a gap in the day before that would need to be filled too before I get a little bit more bearish. And to be fair, it is the 5,700 level, which has served as both resistance and support that needs to hold, and that's kind of my line in the sand. So right now we are still in an uptrend on all the time frames, so no reason to get bearish just yet, except for maybe the day trade time frame. And then we can also take a look at the VIX. The VIX is on the rise a little bit. Let's take a look at the 2-month chart, and we can see that we are just a few days off of these lows down here. Those were near the lows of the year, and then we are just a little bit elevated. Something to watch for, because if the VIX were to go back up to these levels up here, we'd probably see a little bit more downside in the indices. The good news is yields and the dollar, they look like they're trying to roll over right now. We see the 10-year down about 5 basis points. Let me just show you a year-to-date chart, and I'll put some lines on there, and you can see we've been camping out by these relative recent highs for a few days now. And as I said, the RSI, if you're into technicals, looks like we want to roll over right now. Also kind of seeing the same deal in the US dollar index, which recently hit a high that we haven't seen in quite a long time. So the Dixie, coming off of those important resistance lines, we want to keep that in the back pocket and just keep checking in on them. And then just a quick look at the sector action today. Brad did a great job. So Staples, defensive sector in the lead here. And then the cyclical sectors, we see consumer discretionary, but also energy and financials. Those are the leading sectors since the election. Those are leading to the downside. And then I just want to close on gold and silver here. We did see gold have the best day in a few months only yesterday. And let's just check out the year-to-date totals there. This was the election swoon, and now we're coming off of those levels. I'll mention gold futures also still in a solid uptrend on most time frames, maybe not the day trade, but on the short, medium, and longer term ones, yes. Guys.
All right, Jared, thanks so much for breaking that down. Want to get to today's strategy session. Wall Street strategists are out with their expectations for the S&P 500 next year, seeing more gains ahead from most, but slowing from the rapid clip that we saw amid the AI boom. Joining us now, we want to bring in Drew Pettit. He's Citi's U.S. equity strategist. Drew, it's great to have you here at the desk. Let's talk about maybe the action that we have seen here over the last couple of days, because it was one of the things that you pointed out in your note that we're starting to see some of these signs of exhaustion. I guess my question to you is, do you believe this is going to be more of a temporary blip, or do you see this maybe a sign of some of that deeper fatigue?
So honestly, I think this is very healthy to start. We had a really rapid move to the upside. We had a lot of news flow. Election, Fed, bring back geopolitics. Earnings really haven't gone away in that entire backdrop. So I think investors and myself, we probably all need a good 8 hours of sleep here. But this is healthy. Honestly, we think sentiment was getting a little extended. Healthy pullback gives you some upside into the end of the year.
And so, healthy pullback right now, and in what names, what parts of the market would signal that it's a healthy pullback versus something that should cause more concern?
So I think a lot of the Trump-related post-election trades that are coming back in Look at energy today, industrials, some of the consumer names. I think that's healthy to come back in. We really still do like cyclicals here. And then on the structural growth side of things as well, there's still a lot of operating leverage. We got some pretty good results out of that side. I would especially say in communication services. Yeah. Again, this dip gives us a chance to buy back into those trades.
So what does that upside look like?
So right now, we think 6,100 into year end. That's been our bull case for the year. We were getting a little nervous when we got there very quickly post-election. You priced in a lot of good news, maybe on deregulation, maybe on some kind of tax cuts for corporates on the fringes. Yeah, then you have to start weighing tariffs on the other side as well, and just where we are. Again, back to sentiment. It was really, really extended and positive. Again, healthy correction.
We've seen a lot of optimism already start to enter into the fray for 2025 year-end targets. So 6,100 year-end for 2024, 2025. As you look out, what are some of the catalysts that drive you to the targets that Citi is looking at here?
So haven't put our official 2025 numbers yet.
Drew.
Yeah, everyone's needling at this point here, but what we're looking at on the earnings side, and this is where I think we've really differentiated ourselves, doing a lot more bottom-up work on the index. There's a lot of earnings resilience. There's a lot of operating efficiency. What's really interesting on the S&P 500 right now, employee count for the total index has gone up 1% year over year, but sales have grown 5%. So you start to get a little bit more operating leverage in these bigger companies that are top performers in their sectors. We think that continues. We think companies find more efficiencies. And I think that sales per employee is a really interesting number to follow.
With that, has earnings growth mirrored or kept pace how it should when you do have that imbalance, I would say, of the smaller growth in employees versus the revenue?
Yeah, it has. Actually, and earnings growth has been better than sales growth. Earnings beats, they're normally better than sales beats anyways. But you are seeing that show up in the bottom line. And I'm looking at sales per share and earnings per share. So this isn't buyback driven. This is like actually fundamentally, operationally
Sound
driven.
Business, yeah.
Drew, let's talk about Nvidia later on this week, because lots of questions just about how important it is to the market, how much people care this time around, especially given some of the dynamics at play. We certainly have seen a broadening in terms of market participation. How big of a driver do you see that being, maybe more so in that near-term sentiment?
Very, very important still. It's funny, because the beats and raises have been so aggressive for Nvidia, we are expecting, especially like our analyst covering the stock, does see a beat and raise, but a little bit of a smaller one. The difference is for this company versus, well, I guess, and the rest of the Mag 7 combined, you have seen the estimates for 2025 actually stair step higher. Whereas the rest of the 493, you're still seeing some softness here and there. I would say like the manufacturing space still kind of in the doldrums here. But yes, when you have that outsized good revision trend, it matters a lot, especially because it's basically lifting the entire index.
What do you think is then, from what we've heard from companies thus far in the earnings season, and we were just talking to the CFO of Walmart as well, trying to get a sense of, even beyond and through the holiday season, what are going to be some of the biggest drivers as they're going into next year? And of course, as it comes up in every conversation, tariffs are on the mind, and to what extent there is a tit for tat. But beyond that, what is the policy that you think businesses can rally around to continue to see healthy growth for themselves next year?
So it's funny, I'm going to step away from policy on this one, not to like completely dodge the question, but there's a lot of secular trends at work. We always talk about politics, this time of year, every 2 and 4 years, right? But these businesses, they're going to run no matter what. What's really interesting here, there are still secular drivers. We want to talk about AI, but there's a lot of low-hanging fruit still in supply chain management and flexibility. So that's really played into our earnings resiliency thesis for years, and that's not going away. So I think flexibility, I think some optimism around just kind of getting past election uncertainty and eventually getting past policy uncertainty. We're not there yet. But I think we're going to go back to the structural. What can we change? What can we improve? How flexible can we be? I think that's really important for 2025.
Interesting. Citi U.S. equity strategist Drew Pettit, thanks so much for joining us here in studio.
Yeah, thanks for having me.
Appreciate it. It's time now for our chart of the day. Let's send it on over to Catalyst co-host Madison Mills for a look at Nvidia ahead of its results tomorrow. Hey, Maddie.
Hey, Brad. So let's continue the Nvidia conversation. Of course, the moment we've all been waiting for throughout this earnings cycle. We're finally going to hear from Nvidia tomorrow. Now, a big question is going to be the company's revenue growth, which you just referenced in your conversation with Drew here. And take a look at the board behind me. This is the projected revenue growth offered by Nvidia that you're seeing in the green. In the gray here, this is Wall Street's estimates for Nvidia's revenue growth moving forward. And as you can see here, this is starting to trend down. So it's interesting when we talk about the question for Nvidia moving forward. Obviously, this is still to the upside, right? So they're still experiencing that growth. But the question is, will the street be able to handle that downward and de-escalation of growth, even though it is still a growthy name? Notably, in the last 5 quarters here, Nvidia has exceeded the street's expectations, so we could see this forward guidance beating. There is a question about Nvidia's total addressable market. We know that upwards of 40% of their revenue come from just 4 of those hyperscalers. So one of the big questions, can they increase the number of customers that are feeding into their balance sheet moving forward? That's going to require a broader uptick in AI usage from more than just those 4 hyperscalers, which have already poured hundreds of millions of dollars into AI. Are they going to be able to keep that pace moving forward? Another potential catalyst for Nvidia, and this is something that I'm interested to see if it comes up on the earnings call, is that total addressable market, including things like full self-driving technology, which we can expect to be fast-tracked under the incoming Trump administration, given Musk's involvement with that administration. Could that be a positive catalyst for Nvidia's forward guidance as we head into this earnings call tomorrow, guys? That's something that I'm going to be watching for.
You and a lot of people are going to be closely watching that. Maddie, great stuff. Thanks so much. Coming up, the Department of Justice wanting to force Google to sell Chrome. We will dive into what's losing the world's most popular search engine would mean for the company. We've got that for you after the break. Let's take a look at shares of Alphabet. They're currently moving actually to the upside here, up just about 0.5%. The move coming after Bloomberg reporting that the Department of Justice will ask a judge to force a tech giant to sell its browser Chrome due to antitrust concerns. Here with more on the implications For Alphabet and Big Tech, we want to bring in Rebecca Hall-Allensworth, a Vanderbilt Law School Associate Dean for Research and Professor. It's great to have you here to weigh in on this. So yes, this involves this potential sale here of the Chrome browser, but that, of course, is not all. When you take a look at some of the other implications here, or what we're seeing this push here from the DOJ, they also want to impose data licensing requirements, also parts of its AI business. I'm curious just to get your reaction to this.
Yeah, so this is not very surprising. This is just the government's ask in the Google case. So we don't know what the judge is going to impose yet. And I see some of these as relatively unlikely, but it makes sense to ask for more than you think you're going to get. Maybe you hope the judge is going to split the baby somewhere in the middle. And I happen to think that the data sharing part might be the middle. That might be the thing that they actually get, maybe not the spinoff of Chrome.
How big of a deal is this, especially considering where the Department of Justice has looked across some of the strategic acquisitions that major and big tech companies have made in order to make sure that they can grow their business in ways that were innovative at the time, but now are being challenged?
Well, it's a two-edged sword. I mean, you grow your business, you become more innovative, but you also make it harder for other people to compete, which itself impedes innovation. So there's a balance here. And I think that these lawsuits reflect the idea that the balance has been struck too far for too long on the side of companies doing whatever they want and on the side of big tech becoming bigger and bigger and bigger. So the idea is just to recalibrate, I think. I think this is not saying, no more mergers, no more innovation by these big companies. The idea is to just make a little bit more of an even playing field for the sake of even better innovation.
What do you think the strategy is going to look like under a second Trump term? Because this case was initially brought by former President Trump under his first term, of course, continued under the Biden administration. Do you see that changing at all this time around?
It's so hard to say. I think like so many things about the incoming Trump administration, we just don't know. As you said, on the one hand, they brought this suit in the first place, so it would be very strange for them to kind of flip-flop and back off. On the other hand, this anti-big tech, sort of strong antitrust enforcement is really associated with Biden's brand, which Trump is trying to distance himself from, and he's cozied up to some elements of Silicon Valley. So we just really don't know how this is all going to net out. The other point I'll make is that Trump doesn't really care about this stuff. He could hand it off to somebody who has a totally different agenda, and it's just not kind of core to his, I think, purpose.
Rebecca, if we were to see a forced spinoff, I think the question, and I know you're saying that maybe that is not likely, but the question is who would be the buyer? Who would be the buyer given these antitrust concerns?
Well, I think it's unlikely to be another big tech company. I think that would sort of, be a step sideways. But as far as who a buyer would be, I think it'd be very hard to say at this time who that would be. But, I don't think it's going to be Microsoft. I don't think they're going to let Apple take it, for example. This would just sort of recreate the problems that this suit is about.
Do you think this would cause a more seismic shift in how companies evaluate deals if there is a risk that there's one administration that might be seen as pro-deregulation and pro-deal making, just to have that deal then later on challenged if there is another changing in thinking about some of the acquisitions that are being made? And typically it is some of the larger tech companies that have some of the cash on hand to throw around in these instances.
I think this whole antitrust reform movement, absolutely, is going to affect the behavior of big tech. But I don't think it's a flip-flop. So I think this movement is here to stay. It started with Trump. It was continued with Biden. It's happening in the courts. Remember, the courts are the ones that really have the power to do antitrust policy, and it's changing. And big tech will be paying attention to that. So I don't think it's a one administration, another administration problem. I think this is a real change that on some level is here to stay. It's just a little unclear right now on to what extent.
Interesting. Rebecca Hall-Allensworth, who is the Associate Dean for Research and Professor at Vanderbilt Law School. Thanks so much for taking the time with us today.
Thanks for having me.
Certainly. Coming up, everyone, Nestle reveals its plans to cut billions in costs next year. That and more when we've got stocks in the move. Stocks on the move. They're moving on this Tuesday morning. Stick around. You're watching The Morning Brief, brought to you by Invesco. We're taking a closer look at some trending tickers this morning, and we're doing it in 30 seconds each. Let's go. Nestle revealing plans to cut over $2 billion in costs by the end of 2027 as part of its Capital Markets Day. They made that announcement, and that's in addition to the previously planned cuts of over $1 billion. The company's recently appointed CEO also shared plans to spin off Nestle's premium drinks and water brand into a new business. This is going to be effective January 1st. Nestle previously cut profitability and sales outlooks for 2025. I feel like that's been 30 seconds, but that is the nuts and bolts and the chocolate of the business as of right now.
All right, let's move on to the U.S. Department of Commerce raising tariffs on Nippon Steel. The U.S. made the decision after a review of Nippon Steel's sale of hot-rolled steel below value in the U.S. between October 2022 and September of 2023. You're looking at the stock under bidder pressure here this morning. To no surprise, on the two-day, though, we're still looking at gains of just about 3%. Again, higher tariffs will be a bit of a concern here for the company going forward. Obviously has been the target here of the Biden administration. What that looks like under Trump will be something investors are closely watching.
And finally here, let's talk Lowe's, releasing earnings this morning. The company beat Wall Street's expectations on both the top and bottom lines. The company also raised the full year guidance, but still expecting comparable sales to decline here. Take a look at shares right now. They are down by about 4%.
Let's get to a deeper dive here on these results. The latest outlook here for the home improvement sector. For that, we have our very own Brooke DePalma. And Brooke, just taking a look at the initial reaction in some of these numbers, it was a bit disappointing here for Lowe's.
Yeah, shares under pressure this morning after the company changed its outlook for 2024. Investors really honing in on that negative same-store sales growth expected to end 2024. Let's take a look at that future outlook. Total net sales expected to come in the range between $83 to $83.5 billion for 2024. Also, same-store sales expected to come in down 3 to 3.5% year over year, and that's down, or rather closer in compared to the previously expected decline of 3.5 to 4%. Now, Lowe's really waiting for this inflection point within the housing market. The executives within the call saying that consumers continue to face affordability challenges as both inflation and interest rates are putting pressure on consumers' wallets. Mortgage rates remain stubbornly high, as we know, and they also waited on this lack of affordable homes, and housing turnover remains near 30 years low. Now, earnings for today said that ongoing softness in the DIY customer as far as big ticket discretionary demand pulled back, like flooring, kitchen, bath, and decor. Also, we did see that positively offset a bit from recovery efforts because of Hurricane Helene and Milton, but really waiting on an inflection point within the housing market to turn this business around. And the company saying that they're prepared to take advantage and take market share when it does.
You know, you look at a report like this from Lowe's, it makes you think back to Home Depot's earnings that we saw just last week. They were talking about macroeconomic uncertainty remaining. What are some of the similarities and the differences between these two entities that are both operating in the same part of the retail sphere?
Yeah, well, what's interesting is that Home Depot also beat across the board, but investors really weighing in on this inflection point, weighing in on when exactly this market will turn. And we're actually seeing Home Depot under pressure this morning because of this Lowe's report. Shares now of Home Depot down roughly 2.2% in early market trading here. And we saw revenue jump 6.6%. We saw adjusted earnings per share come in higher. We also did, though, see same-store sales continue a decline. Now, for Lowe's, this is the 8th straight quarter of same-store sales decline. And what we saw with Home Depot is a similar notion that they continue to see this negative sales growth because of this environment where DIY customers are pulling back and they're doing less projects because it costs more.
I've just been getting more creative with my DIY projects that I'm doing.
Have you been?
doing?
The tools that I'm getting from Home Depot.
Okay.
Yeah.
Well, you have to give me some secrets.
Shaved
I
a
need
sweet
to get
potato
on that.
with a power
Painting
drill.
your
I
own.
actually saw that over the weekend. It was very, very creative. I'll give you that.
Was it more efficient?
TikTok taught
It
me.
looked efficient. I don't know how
Sweet
effective
potatoes
it
with the power
was.
drill, everyone.
There was some cleanup work.
Yeah,
I
it looked
bet.
like it. All right, Brooke, great stuff. Thanks so much. Keep right here on Yahoo Finance. That does it for Morning Brief. But join me and my co-host Madison Mills. We've got you for the next hour. More analysis on what exactly is moving the markets in your portfolio today. That's coming up next on Catalyst. Welcome to Catalyst. I'm Shauna Smith alongside Madison Mills. 30 minutes into the trading day. Let's get to the 3 catalysts that we're watching this hour.
First up, we bring you the market latest as investors grappling with geopolitical tensions ahead of Nvidia results.
Plus, we'll break down the latest retail earnings and look ahead to the impact tariffs could potentially have on the industry.
And we'll take a deep dive into crypto and where Bitcoin is heading with Mike Novogratz of Galaxy Digital. The Russell 2000 falling as the pullback from the post-election rally continues. Small caps down over 4% in the last 5 days as concerns over higher for longer rates set in. The next key catalyst for investors will be Nvidia earnings out tomorrow. So what could the results mean for the rotation into small caps? Joining us now, we got Mike Reynolds, the Vice President of Investment Strategy at Glenmead. Mike, always great to speak with you. I know you've been more bullish on small caps for a little while now. If we do get a disappointing result for Nvidia, is that going to be enough to turn around some of the downward pressure that we've seen in small caps lately?
Thanks. Happy to be here. Our perspective on small caps is that we have really these dual tailwinds right now of fair valuations and earnings growth expectations that are really expected to pick up into 2025. Now, we think small caps have pulled back a little bit on expectations that the Fed's going to be a little less aggressive on its rate cut campaign. We think that that's rate cuts that are likely postponed, not just canceled. Overall, we think our thesis on small cap outperformance over a, call it medium to long-term range is still relatively intact despite some of these near-term headwinds.
Mike, what do you think the earnings growth trajectory is going to look like for small caps when you compare it to its larger cap peers?
Yeah, going into 2025, we're expecting some pretty meaningfully better results, 20% plus, whether you're looking at the Russell 2, the S&P 600, versus closer to 10% for the S&P 500. This comes after a period of a couple years where small caps just pretty serially under-earned relative to their larger counterparts. And we think there's a catch-up here. We think we're starting to see the early signs of it. We may even see some really early signs of it in Q4 earnings season, so we're watching that really closely.
Yeah, what is the biggest driver of that turnaround story, Mike? You mentioned earnings prospects. Where are you seeing evidence of that growth kind of across the board versus just in individual names?
We're seeing it pretty much across the board. And look, we think it's a relative game here versus the largest of the large and the small companies. You know, I'm a big fan of the show. And Madison, I heard you refer to the bond market as a stable boyfriend not too long ago. I actually want to take that analogy one step further. From our perspective, the Mag 7, which have really been driving this market, are kind of like the guys with a few red flags, but the girls seem to chase them anyway. I think investors are starting to ask themselves what sort of earnings growth expectations are built into those premium valuations and whether it's reasonable to attain those. Take a look at the flip side on small caps, and you've got really decent valuations, really right at fair value from our perspective, where it actually just doesn't take much to get over that hurdle to see them outperform once the earnings and the underlying fundamentals start to improve going forward.
I guess then my concern, Mike, is what if we don't get that earnings growth moving forward? What happens to small caps then? Would it be relying a little bit too heavily on a Fed that might be impacted by an incoming administration that could change the path forward for rate cuts?
Yeah, again, the thesis for small cap is underlying, underpinned from both the earnings and the Fed sort of impact from lower rates. From our perspective, small caps are much more sensitive to Fed funds. In particular, their debt stack is much higher in floating rate coupon debt, which should be more directly sensitive to the Fed's rate cut campaign. And look, again, we expect the Fed's going to be less aggressive on the rate cut campaign going forward than perhaps we had expected just a month or two ago. But the fact of the matter is we think that Fed funds is still on a real basis materially too tight. Now, does it mean we get to neutral within the next couple months? Probably not, but we think the Fed is going in that direction. Investors that sort of have the patience to play this over the longer term, we think are really going to be rewarded here.
Mike, I'm curious just to bring you back to some of the movement that we're seeing here this morning. Clearly, we're looking at a bit of pressure. Geopolitical risk is back in the forefront here. How are you evaluating that just in terms of how much pressure we could see on the markets here in the short term?
Yeah, in some sense, it's not all too surprising to see geopolitical tensions flare up in the lame duck session right after you have a presidential election. So historically, we would expect that this is kind of par for the course. it's very hard for investors to sort of get an information advantage around these types of geopolitical events. As an investor, you sort of need to know your limitations. If you don't have an information advantage, you probably don't want to be trading these types of events. And if you have a well-diversified portfolio, you should be able to weather these events as they sort of come to fruition and see themselves out over the long term.
And Mike, you mentioned in your notes you sent over that we are late cycle. That creates more volatility. Obviously, the geopolitical backdrop creates volatility. Where should investors be seeking some safety if they are concerned about the path forward here?
Sure. So we recognize we are late cycle. We're looking for those measures of excess that sort of tend to tip you into recession. We're not seeing meaningful signs of that right now, but you got to stay vigilant in this sort of environment. You have to sort of be selective with the bets you're taking in your portfolio, avoiding some of the most expensive names in the equity markets, but also opportunistically playing some foreign markets that we think are materially underpriced, in particular Japanese equities. We continue to see ongoing governance tailwinds, and perhaps even the currency could be a tailwind for US-based investors that don't hedge their exposures. So it's really selective bets you need to be taking in your portfolio as you're in the late stage.
All right, Mike Reynolds, Vice President of Investment Strategy at Glenmead, thank you so much for joining us this morning. We appreciate it. Let's take a look at some market headlines to kick off our hour, sponsored by Tasty Trade. Taking a look here first at the major averages, let's see if we are still seeing some pressure across the screen, and we are here. The Dow Jones still under pressure. The S&P 500 moving below the flat line. It looks like the NASDAQ is down about 0.3%, if I can see that correctly on our screen here. I also want to flip the board over to the bond market and see if we're still seeing yields moving to the downside, and we are here. The 10-year fairly off of that 4.5% level, continuing to move to the downside. Finally here, I want to take a look over at Bitcoin, actually popping back up. We saw Bitcoin under pressure this morning, but still above that 90,000 level, and now taking a bit to the upside, hitting just over 92,000. Coming up, we're taking a look at today's trending tickers. We'll give you the news behind the moves next, right here on Catalysts. It's now time for some of today's trending tickers. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. First up, Trump media reportedly in talks to acquire crypto trading platform Bakkt. Yahoo Finance's Alexandra Canal joining us now with a closer look at the potential deal. Ali, I know you cover Trump media very closely. What can you tell us about what this move might mean moving forward?
Well, we saw DJT stock close over 16% higher on Monday when this report first came out from the Financial Times over this acquisition. Bakkt, meanwhile, gained over 162% on Monday. Now we're seeing DJT shares lose today. Their stock is down about 8% at the moment. Bakkt, meanwhile, is extending gains up about 7%. If we take a look at the market cap, Bakkt has a market cap of $206 million. A lot of that, the gains that we saw yesterday, pushing that market cap higher. Obviously, 162% rise, probably a bit of short selling there. And then you look at Trump Media and Technology Group, that has a market cap of around $6.5 billion. So perhaps an acquisition with equity potentially. But this is a very interesting story considering the many layers here. Trump is a majority owner of DJT. He owns a 60% interest in the company. This is a company that owns True Social, which is a social media company that he founded after he was kicked off those major social media platforms like X and Facebook following the January 6th insurrection. He has since been reinstated on those platforms, but we know that DJT as a company is one that consistently loses money. However, since Trump was announced as the next president, he has been closely tied to the rally that we've seen in Bitcoin, and Bakkt is a crypto exchange. So it's very interesting to see how that could potentially be something to look out for down the line, considering that Trump and his administration, it's been viewed as more friendly to crypto regulation. He's made promises that include appointing a crypto presidential advisory council and firing current SEC chairman Gary Gensler. And we see Bitcoin prices trading to the upside today, up about 2%. Also, another interesting note here is that Bakkt has seen its stock fall pretty significantly since 2021. Intercontinental Exchange is the majority owner there that owns the NYSE. And it's led by CEO Jeff Sprecher, who is married to former Georgia Senator Kelly Loeffler, who was the co-chair of Trump's inaugural committee. So again, a lot of very interesting webs, a lot of interesting layers when it comes to this potential deal. But according to the Financial Times, they are in advanced talks. So just something to keep an eye on.
Keeping it in the family and
Yes.
in the Trump close circle, something we've seen him do numerous times with his business dealings. Ali, I'm curious, do you think the street is looking at this favorably, or why should we, or how should we be reading into, I guess, the interest that we're seeing in Bakkt?
I think when it comes to anything with Trump's name attached to it, it's hard to look at this as a fundamental story. I mean, like I said, Bakkt as a company, it has been struggling financially. It is down pretty significantly since its IPO, excluding that pop that we saw yesterday. And same with DJT. It is not a company that really generates a lot of revenue. It actually consistently loses money. So I think this is a gut reaction from maybe investors looking to make a quick buck here. And certainly that's been the case for DJT, as we see shares sort of oscillate between these highs and lows, tied a lot to whatever the election odds were. Now it sort of seems like, okay, now that we know Trump is going to be in office, we know he supposedly wants to be more friendly to crypto. Could this be a play down the line? And once the president-elect does get into office, I think how DJT trades will be interesting, and with the purpose of the company too. Is this going to be a place where Trump, favors over a site like X? Is he going to make announcements on DJT? Is True Social going to be a company that really people need to be paying attention to? So all of that is a big question mark here. And if it sort of fades into the background, I don't see how the stock can do well. But again, it's sort of had this insane rally over the past month or so since Trump was announced as president. So it's going to be a very interesting journey, I think.
Certainly moving like a meme stock,
Yes.
Ali. Thank you so much for bringing us a great reporting on that. As always, really appreciate it. Thank you. Another trending ticker today that we are watching, HPE. The company reportedly met with Justice Department leaders to persuade the agency not to challenge its proposed $14 billion deal with Juniper Networks. We spoke to HPE CEO about the deal last month right here on Catalyst. Here's what he had to say.
We are excited about the acquisition, and we have said from the beginning that we expect the transaction to close end of this calendar year or beginning of calendar 25. So we are weeks away. Think about it, right? So the timeline's still the same. We have been having a very productive process with our regulators, and hopefully we can close this soon so we can tell the market how this transaction will work for them, not just from the synergy perspective, but from the use of this amazing technology together with HPE's intellectual property on accelerating both hybrid cloud and AI.
So, Shauna, obviously you were in that interview, so I'm curious to get your thoughts on the conversation with the CEO. But what I'm interested in the conversation here, too, is the regulatory clarity that we've already gotten in other countries. The UK, the EU have already cleared this deal. So why is the Justice Department kind of dragging its feet on it? And what does that difference mean in terms of how this current administration is viewing anti-competitive practices and whether or not Juniper and HPE are going to be able to delay this in order to wait for a potentially more favorable administration?
Yeah, and I think there is so much uncertainty, and I think that's why we've seen this back and forth, especially how the market has been reading it. I think overall they do remain optimistic that this deal is going to happen, although I think you take reports like this and you take the fact that there has been some sort of pressure here in this final mile as we do lead up to that deadline that, hey, this isn't a done deal. And we could see the possibility of this going the wrong way depending on how you look at it, but the wrong way from HPE's perspective and ultimately what that means here for the company going forward. I was looking through some recent analyst reaction or notes on this, and they all seem pretty upbeat just in terms of the prospects of this getting done. You had Raymond James out earlier this week, yesterday, talking about the fact that they're seeing some real upward opportunity here in terms of that market share TAM that they could potentially see HPE with the close of this Juniper deal and what exactly that is going to do for the AI side of the business. So I don't think it's necessarily a surprise, just given how much uncertainty there has been. I mean, we were talking to a guest last hour about the DOJ's pressure on Google, a very, very different story. But again, she was just talking about the fact that there's so many unknowns right now. And I think that is certainly playing into the market. I think that is capping maybe some of the optimism to a sort of degree. But I do think, at least when it comes to this deal with HP and Juniper, the street does remain optimistic that it will get done.
Yeah, really interesting overview in terms of the analyst reaction there too, Shauna.
All right, let's take a look at Walmart beating third quarter expectations, raising its full year guidance, boosted by demand for groceries, toys, and other goods. We talked to the company's CFO last hour, John David Rainey. Take a listen to what he had to say about the impact of potential tariffs.
Tariffs are inflationary for customers, but we want to work to bring down prices. Right now, this is speculation. We don't know what categories of items could, or even what countries tariffs could apply to. We are familiar with this, and if we look back historically, when tariffs were enacted 7 years ago, it did result in higher prices for customers.
Let's bring in Oliver Chen. He's TD Cowen's a senior research analyst. Oliver, you just heard what John David Rainey had to say to the question. I'm curious to get your perspective, though. The risk of tariffs right now, how big of a risk then is that, do you see, for it being here to Walmart's business?
Well, the big question is how much of this will or can be passed through to consumers. It's not a very high margin business, so there's risk, and the pass-through will be necessary given that it's a low margin business. Walmart has the most scale, so that's quite a powerful place to be. And Walmart continues to be focused on everyday low prices. And they've been through tariffs before, as has retail. So they're in a great negotiating place. They have scale, and everything is working. The customer is shopping at Walmart. It's our best idea. And the beat and raise was quite exciting today in terms of Walmart is seeing consistency while others are seeing a lot of volatility. This focus on value meets technology is really a winning formula in this environment.
So it's interesting you mentioned, Oliver, that Walmart and other retailers have been through tariffs before, and we hear from proponents of tariffs that it's really a one-time impact. What does that tell you about what earnings growth could look like moving forward if we do in fact see those 60% tariffs? How are you kind of modeling and looking at the impact that could have on forward guidance for Walmart?
Yeah, what we've looked at is a lot of sensitivities. So if tariffs are above 50%, for example, earnings per share could be weighed down by 10% or more. The main variable is what percentage of these increases can be passed on to consumers. That will be a tougher question, and it's a tougher question in terms of the middle and low income consumer facing pain right now. That being said, the bottom line, many companies will be impacted, and those with scale will benefit benefit more. Those also that have need-based businesses, such as Walmart with 60% grocery, that's a key winning factor. We are also excited about artificial intelligence and productivity improvements, the marketplace model, digital advertising. So these are other ingredients to help the margin. But the main question here, what will be passed through, and the main financial impact in terms of modeling, about 10% or more.
Oliver, when you stack up Walmart's business to, say, Target, one of its biggest competitors, is Target then maybe more exposed to the potential tariffs? And I guess what other companies would we see maybe more of an impact?
Yeah, Target has a lot more consumer discretionary. So yes, it is, whereas Walmart's about 60% food. And this customer under pressure, that consumer discretionary trends can be a lot more volatile than food. Another company, ELF Beauty, they supply a lot from China. That will be something to watch as well. I think it will impact all of our companies, though. Those with more consumer discretionary mixes are more at risk. Those with less pricing leverage are more at risk. Luxury is partially insulated. We like Louis Vuitton, but things aren't great in China either. So there's lots of cross currents, and this is all a negotiating starting point. Fortunately, supply chains have been through a lot. So they've been battle tested for what we're seeing. Furthermore, we've been discussing tariffs for the past few months, if not more. So management teams have had time to think about it and run sensitivities. The main question is how will consumers respond when you raise prices, and which products can you raise prices on and which can you not, and will consumers accept this? It'll be a battle.
We've talked a lot about Walmart. I want to get your take on Target. We've seen them continue to be under pressure, and you mentioned watch those with a lot of consumer discretionary exposure, and they seem to have a lot more consumer discretionary from where I sit. How are you looking at Target?
Yeah, we're cautiously optimistic. We're excited for the new CFO. That being said, apparel trends are something to watch. What's good is Target is facing easier comparisons of negative numbers last year. What's also good is last quarter at Target was better than expected, and apparel was slightly positive. General merchandise numbers were positive today at Walmart. That bodes well for Target. Also, there were commentary today, specifically home and toys doing better at Walmart. So we're hopeful that Target is also seeing that trend. Target needs to continue to focus on value. It's known as Target in terms of the private brands. That's a big important point too. And it will be a battle for the dollar. The Thanksgiving meal being less expensive at Walmart in terms of their everyday low price and under $7 per person. All these things are really important in terms of winning this customer in this environment.
Oliver, you mentioned Thanksgiving, so I got to ask here, how do you see the holiday season shaping up for these two retail giants?
Yeah, mathematically, we're seeing 5 fewer days between Thanksgiving and Christmas, so that's something to watch. We've seen really mixed weather. What we like about Walmart is today they printed a very solid traffic number and unit number. That bodes well for continued momentum. Target's been more volatile, but they're focused on deals and values. Overall, the holiday season should be in the plus low single digit range, but what we're fearful of is promotions, and everybody's waiting for the best deal, and there's really fierce competition relative to Amazon. Our top idea does continue to be Walmart. We're a market perform hold rated on Target. Target is a retailer we're watching. Walmart's a more expensive stock, but we think it's worth it. We also like Costco, which is an extreme value retailer as well. Those are things we're looking at.
30 seconds, Oliver. Does the shortened holiday spend time mean better deals for consumers due to those Black Friday sales?
We see stretched out deals. So there's been deals throughout, and it's been a little watered down. Black Friday used to be about theater and maybe getting trampled, in stores and looking for Nintendo and Cabbage Patch Kids. But it's completely changed where it's a little spread out. But there will be a rush. Also, there'll be a rush with the shipping cutoff dates, and supply chains will be under pressure. Better deals than last year. I think they're going to be quite similar and comparable, to be honest.
Nice. All right, Oliver, good to know for the consumers wondering out there. Oliver Chen, TD Cowen Senior Research Analyst. Thanks so much.
My pleasure.
Coming up, recent data is reshaping the market's expectations for a December rate cut from the Federal Reserve. We'll take a closer look at the factors influencing the central bank's next moves on Catalysts.
A string of strong economic data reshaping Wall Street's debate over the timing of the next rate cut. Last week, Fed Chair Jay Powell signaled that he wasn't in a rush, saying that there's no need for policymakers to be, quote, in a hurry to lower rates. Those signs of hesitancy coming as Wall Street attempts to game out how inflationary President-elect Trump's push for tax cuts and his push for higher tariffs could potentially be for the economy. Joining us now to discuss, we want to bring in Jeffrey Roach. He's LPL Financial's a chief economist. Jeffrey, it's great to have you back here on Yahoo Finance. Talk to me just about how you're looking at the prospects of this and how you see Trump's potential policy here influencing the timing of rate cuts.
Right. Well, there has been a lot of unknowns really starting back in August going into the September decision that the Fed had. Of course, as you remember, a jumbo supersized cut, 50 basis point cut, then a little bit risque in that sense, a little bit more than what markets expected. And now the pendulum has swung perhaps a little bit to the other extreme with the no hurry comment recently from last week. I think it boils down to this. The Fed has to accept that data dependency has its inherent risks, right? Especially when you throw in data revisions to that. And so, I think at this point, it's going to be a little bit choppy when in addition to what I already mentioned, you had weather related disruptions. So that's going to be a little bit of a tough time interpreting the next upcoming payroll report. I think it's going to be hard for a December cut for a couple of reasons. Is the payroll number might actually be a little bit hotter than quote unquote it should be, given the fact of payback from the previous month. And you might have a little bit of those base effects giving our inflation data a little bit hotter, not necessarily a change in trend, but perhaps some of those month-on-month numbers are going to come in a little bit hotter. So that's going to put a little bit of headwind, I think, for those expecting a December cut. Although at this point, it's somewhat of a coin flip.
So what does that mean for where you see the neutral rate more long term? Neil Kashkari spoke with Yahoo Finance's Jennifer Schomburger at our Invest event, and he talked about how the just resilience of the consumer combined with some impacts from the incoming administration could require a higher neutral rate. What is your take on that?
Well, I think the neutral rate could be a little bit higher. And I think we actually see that when we read the previous summary of economic projections. Fed releases those periodically, not after every meeting. We'll get an updated summary after the December meeting, but we've seen them slowly inch up, 2.8 to 2.9 to 3.0 perhaps. I think one of the things that could argue for a slightly higher long run rate is the fact that the millennials already starting to reach their peak spending, peak earning stage. They're probably going to be the beneficiaries of this greatest wealth transfer in history that we're talking about from the silent generation and baby boomers passing on inheritance. This is probably a longer term trend that we have these millennials becoming a greater powerhouse in consumer spending, and perhaps the consumer and the strength of the consumer might last a little bit longer. And I would not be surprised if there's more and more conversations that long run rate needs to be a little bit higher, but still hover around 3%.
So then what are your expectations then in the short term for this fight to tame inflation? We certainly have seems, at least maybe for now, the latest wave might be more of a head fake than anything that really materializes. Is that going to continue then to be the case, do you think?
Well, I think the Fed is probably going to embrace this cut and pause cadence where they perhaps pause in December, but if they do cut in December, they're definitely going to pause in January. So the cut and pause, making sure that these slight upticks in the annual metrics of inflation are certainly head fakes, not necessarily a change in trend. Now, granted, tariffs and the risks of that certainly throwing a wrench in forecasts. But at this point, think of it as a cut and pause cadence.
One of the names on Donald Trump's shortlist for Treasury Secretary is hedge fund manager Scott Bessent, and Catalyst spoke with him back in July, and I asked him about Trump's proposed tariffs. Here's what he had to say.
We hear 60% tariffs on China. That's the beginning of a maximalist negotiating position. That's the way President Trump negotiates. I would be surprised if we ever hit that. But I think, given his record in Trump 1.0, he has a lot of credibility in using tariffs to negotiate.
So, Jeffrey, what is your thinking then on how we should be thinking about tariffs and the potential economic impact moving forward based on what you just heard from Bessent, that we may not necessarily see that 60% level?
Well, I think, two things taken away from that clip that you just showed. It's absolutely true that the rhetoric doesn't always translate into some action. So there's certainly going to be hot rhetoric. But I think the second thing that's really interesting is the fact that China and the U.S. are in very different situations right now, 2024, relative to where they were 2017, 2018. China was growing a lot faster then. U.S. was growing and slowing a lot faster then. The tables have completely turned. And so the reason why that's so relevant is I think that Chinese producers are going to be a lot more interested in to try to keep their business, keep volume, right? When you think about a tariff, who's going to pay for the tariff? Well, it's either the end consumer or it's the importer, the domestic importer here in the U.S., or part of the burden is going to be paid by the foreign producer overseas. I think the scenario now probably puts less pressure on the end consumer, more pressure on the foreign producer overseas, given the macro landscape now.
That would certainly be good news on the inflation front, Jeffrey. Thank you so much for joining us this morning. We appreciate it. That was Jeffrey Roach, LPL Financial's chief economist.
Thanks.
Coming up, we're going to sit down with Galaxy Digital CEO Mike Novogratz as Bitcoin pushes up against its all-time high. That's coming up next right here on Catalysts.
Microsoft unveiling its first products using Nvidia's most advanced chip at its Ignite event this morning. Blackwell demand is going to be the key focus for investors when Nvidia reports earnings tomorrow on Wednesday. Akiko Fujita joining us now to explain why investors have so much hope riding on this specific chip. Akiko.
Hi there, Shauna. Yeah, Nvidia CEO Jensen Huang first unveiled the Blackwell chip back in March, calling it a very big GPU, and it is quite literally that. Blackwell is Nvidia's most advanced graphic processing unit that has the ability to run 2.5 times faster than its predecessor Hopper in training AI. And that speed is critical as these AI models get larger and more powerful. Now, to understand the complexity of what Nvidia is developing, we can look at the makeup of the most advanced Blackwell chip. It is made up of 208 billion transistors. These are tiny switches that make these chips work. Its closest competitor, AMD's MI325X, has 153 billion transistors. And that count is important because it points to just how much these GPUs can process at any given time. Now, when you combine the specs, the Blackwell chip is 5 times faster than its predecessor when it comes to inference, the process of AI models using to draw conclusions from new data. And when it comes to energy efficiency, it is 25 times more efficient than NVIDIA's previous chip, Hopper. All of this is in one Blackwell chip. But what makes this chip attractive is its ability to build out a super chip known as the GB200. It combines 2 Blackwell GPUs and 1 Grace CPU. Now, NVIDIA has designed customized server racks that allow AI companies to combine 72 of those GPUs on racks stacked on top of each other. The company has promoted that as the best way to connect the chips to get the fastest performance. It is the reason why you've got Meta, OpenAI, and Microsoft among the companies that have put in massive orders. And for some context, those 72 GPU racks combined weigh 3,000 pounds stacked on top of each other. It is taller than the average refrigerator. And you've got Jensen Huang saying there is huge potential in terms of revenue for this, guys.
We certainly have been hearing that from Jensen, but we've also been hearing about some issues reported with Blackwell overheating. How quickly can NVIDIA ramp up its supply given some of those issues we've heard?
Yeah, Maddie, that's certainly going to be the key question investors have going into that earnings call tomorrow. It was just yesterday the information reported new overheating issues stemming from those server racks. And that came after the company delayed the production and delivery of Blackwell by at least 3 months because of some design flaws they uncovered. Now, all of this points to just how complex these chips are. But there is significant upside potentially here for the company. Jensen Huang has said that this is a market that will start at $250 billion annually. And when you ask investors on the street, there's a difference of issues, or I guess opinions, in terms of how significantly this can ramp up. Piper Sandler's Harsh Kumar says there is potential for NVIDIA to pull in $5 to $8 billion of Blackwell revenue in the January quarter. Raymond James analyst Srini Pajuri cautions the ramp up may take a little longer. He expects NVIDIA to ship 100,000 Blackwell GPUs in the fourth quarter. That would be at the low end of investor expectations. But he still has a strong buy rating on the stock here. So that just points to the potential upside that investors see coming through from Blackwell. Guys, the question is just going to be how quickly they can ramp up, when those deliveries will really start to accelerate. A lot of questions going into that report tomorrow.
Certainly a lot of questions, Akiko, but you gave us a great overview of what to take a look at. So thank you so much for joining us. We appreciate it as always. Now, all eyes are on NVIDIA ahead of the company's third quarter earnings report due out tomorrow after the closing bell. With at least 40% of NVIDIA's revenue coming from just 4 hyperscalers, one key question: do investors need to see a broadening out for the chip giant's growth story to continue? Cisco is one of many companies using NVIDIA's chips. So we're joined now by Jeetu Patel. He is Cisco's EVP and Chief Product Officer. Thank you so much for joining us. We appreciate it, Jeetu. So I'm curious, just ahead of NVIDIA's earnings and as one of NVIDIA's partners yourselves, how much of a bellwether are their earnings for your own company's demand picture?
Right now we are going through such an amazing, kind of unprecedented move towards AI, Madison, that And Nvidia is the one who's actually, kind of set the tempo in the market. But what we are seeing right now is this is akin to the gold rush, where, if you look at what's happening, the companies that make the picks and shovels, the core infrastructure, tend to benefit quite a bit from it. And in the short term in AI, what you'll find is there's a huge amount of overestimation and hype that people might have, but in the long term, people grossly underestimate the impact. So virtually every assumption that we have as humans over the course of the next decade will be challenged and kind of rethought and refactored as we go through it. And as we have actually started to see, what's happening is customers are largely struggling right now with, there's too much complexity, there's safety issues in AI, and there's skills issues in AI. And those are the areas that probably need to get sorted as the higher order bits to make sure that we can really continue this momentum in AI.
So G2, what's the exact or direct impact then on Cisco's business? And when you talk about the impact here or potential for the growth in sales, I know you have $1 billion of AI orders you're expecting this fiscal year. What does that number then look like 1 to 2 to 3 years out from now?
So if you take a step back and say where exactly, if you look at the AI workloads, there's conventional wisdom has been there's 3 core areas that are very essential for AI, which is compute, the actual models and algorithms, and then the data. What you're now starting to see, something that we've known for a long time that is actually going to be pretty common knowledge now, is that there's 2 other elements that are pretty, foundational for that core piece, which is networking and security. You got to have low latency, high performance networking, intra GPU in the back end as you're training the models. And you also need to make sure that you've got security so that you can secure the AI models itself, so that organizations feel comfortable with making sure that these use cases start going out at mass scale. And so we are, as you mentioned, we've said that we're going to have about $1 billion in orders this year, and we will continue to see that growth because there's actually going to be a fair amount of demand signal that we're seeing right now for the underlying networking and security infrastructure, in addition to compute models and data, all 5 areas where Cisco actually plays pretty well.
How much of that $1 billion can be attributed to whales, for lack of a better term, versus some smaller businesses that are looking to expand in AI?
We're actually seeing a pretty, good distribution even in the enterprise, where in fact you're starting to see repatriation of some of the data centers that are also being moved back into the private data center, and organizations want to make sure that they actually have, some of their, core infrastructure that's ready for AI. So modernizing AI data centers that they might have, as well as making sure that they get to be AI-ready data centers, are 2 areas, even in the enterprise, not just within hyperscalers, that we're starting to see a fair amount of demand for.
G2, I know you recently conducted a survey here. Nearly 8,000 organizations took part in it. You were asking about AI Readiness Index, what exactly that looks like. I'm curious, what did you hear back from some of the leaders just in terms of how prepared they are to invest in AI?
One of the things that there's a fair amount of appetite and preparation for AI, but there's only 13% of the organizations say that they're ready to deploy AI fully. And that's because of the things that we talked about. The complexity is still pretty high for AI infrastructure. And then there's the AI safety and security issues. One of the things that we want to do at Cisco is make AI infrastructure plug and play ready, so that it just reduces the cognitive overload for organizations as they start to get their applications ready and their core infrastructure ready to make sure that they can prepare for a huge uptick in demand.
I know you also mentioned that one of the top 3 challenges for companies who are looking to ready themselves on AI is the lack of the right skilled labor, the right manpower in place. I'm curious, in your conversations with other partners, customers, and companies, has anyone expressed concern about how the incoming administration's immigration policies could potentially worsen that challenge for skilled labor moving forward?
I think it's too early to tell, but one of the things that we've always believed is skilled labor. That's, one of the bedrocks of America is making sure that we actually encourage legal immigration of skilled labor. And that's something that we continue to remain optimistic with, and we'll work with the government. I think it's too early to tell what the policies are going to be just yet.
G2 Patel, Cisco's Executive Vice President and Chief Product Officer, thanks so much.
Thank you for having me.
Keep it right here on Yahoo Finance. You're just about an hour and 15 minutes into the U.S. trading day. You're looking at some pressure here across the board. We got much more on that straight ahead.
Are you ready to master the markets and, dare I say, become a better leader in the process? Well, Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor or you're just starting your financial journey, we offer invaluable market insights and strategies to help boost your portfolio, build your wealth, and make you a successful investor. Now let's make some money and get a lot smarter.
I've done Yahoo Finance forever. This is a spectacular spot.
Welcome to Stocks in Translation. I'm your host, Jared Blickery.
Hello, world. I'm Ross Mack.
Hi, I'm Bob Powell, and welcome to Decoding Retirement. Welcome to Living Not So Fabulously.
Hey, it's me, Tiffany the Budgetnista, your favorite financial educator. Welcome to Capital Gains World. For a few days and everything has changed.
From Wall Street to Main Street to the C-suite, we are your daily lifeline, because behind every great investor is Yahoo Finance. Join us on yahoofinance.com, the Yahoo Finance app, or wherever you get your podcasts.
It's a jam-packed hour focusing on the biggest movers and shakers on Wall Street.
This is market domination, and here, every day is game day.
We have 1 hour left until the market close.
It's game time for investors to make their final plays.
The clock is ticking, and we've got you covered with our quarter-by-quarter playbook.
We're bringing you in on all the market action.
With step-by-step analysis of our biggest trending tickers.
And expert insight into the day's biggest headlines.
We'll bring you the closing bell and get you to the finish line.
This is Market Domination.
Tune in daily from 3 to 4 p.m. Eastern.
Bitcoin is back near its all-time high it hit last week amid the post-election rally. This coming as the SEC approves spot ETF options for the NYSE and the NASDAQ, which is planning to list options on BlackRock Bitcoin exchange-traded fund as soon as today. Joining us now to discuss is market domination host Julie Hyman. And Julie, this could be a big win here for the industry.
Well, it could maybe even more juice the volumes that we've already been seeing. Now, that ETF you were just talking about is IBIT. That's the ticker on it. And it has been the monster amongst all the ETFs that got launched this year, right? It run by BlackRock's iShares. You see there the funds that have been, the fund flows that have been going into that ETF, which is, set records basically for the speed relative to size at which we have seen the additions there. And it's really interesting. I talked to Robbie Mitchnick yesterday on the show, who is the head of digital assets at BlackRock. So he oversees this product. And he said, it wasn't necessarily setting up to be a good year for Bitcoin. He said, among other things, you had the liquidation related to some bankruptcies that were happening this year. So that was selling pressure in the market. The ETFs have really saved it. Save the flows, and now add to that the election, which of course has supercharged what we have seen. Now you get the options approval on this ETF. Other options on ETFs are set to start trading either today or tomorrow. And so you could see even more volume activity, but also potentially volatility, which can sometimes come in when you get these kind of options products. Now the industry is awaiting the naming, not just of Treasury Secretary, but probably more pertinent to the crypto industry, who's going to be head of the Securities and Exchange Commission. And the Wall Street Journal reported yesterday that the Coinbase CEO, Brian Armstrong, was meeting with President-elect Trump to discuss just that. Armstrong's pick reportedly could be Hester Peirce, who was an SEC commissioner appointed by Trump and an ally, or seen as an ally of the crypto industry. So, in other words, there are still some potential catalysts here that those in the cryptoverse are looking for.
Well, one thing I thought was really interesting, Julie, from your interview with BlackRock yesterday was this question of whether it's a risk-on or a risky asset. And in the context of this kind of safe haven bid we're seeing in bonds today, I'm interested in what you think about whether or not we're going to see Bitcoin become this safe haven move.
No. Is in a short, what I take away from that conversation with Mitchnick is that when he said it is a risky asset, it is risky, it is volatile. When he said it's not risk on, he was implying it is not correlated with stocks or with sort of the risk on segment of the stock market. And if you look at Bitcoin, it doesn't correlate well with anything. And so that's why, yes, certainly some people see it as a safe haven asset, and they go into it when they're concerned about geopolitics or, the soundness of what those crypto folks like to call fiat currencies, sort of belittling those currencies. But it doesn't correlate with anything. So it's hard to see it have a safe haven asset if it doesn't regularly trade inversely with those risk-on assets, if that makes sense.
Makes a lot of sense, yeah. All right, well, Julie, thank you so much for bringing us your amazing reporting on crypto, as always. We really appreciate you giving us your expertise. Thank you so much. And also tune in tomorrow because we're going to have Mike Novogratz, Galaxy Digital's CEO, Julie Hyman, also bringing us that interview. So keep your calendars marked for that. We're going to take a look now at the major averages here. Still looking at moves to the downside, I believe, across those major averages. If we're able to pull those up, I'll call out what we're seeing. The S&P 500 moving just below the flat line, though the NASDAQ picking up a little bit of a bid to the upside, up just over 0.2%. We're seeing Nvidia and SMCI as the biggest, most active tickers in the NASDAQ this morning. Also want to flip the board over to the bond market. Still seeing pressure across the board when it comes to yields. The 10-year hitting at 4.3.
Coming up next, it's Wealth, dedicated to all of your personal finance needs. Brad Smith has you for the next hour. We'll see you tomorrow.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, the tools, the tips, and the tricks that you need to grow your money. Hey, on today's show, stocks to watch heading into 2025. We'll discuss how to view your investments in the new year with a portfolio manager. And breaking down retirement savings moves. One expert says it's time to move your funds from IRAs to a Roth. We'll ask why. Plus, strategies for growing new money and preserving old money, and potentially how to turn new money into old money and build that generational wealth. All that and much more during today's show. But first, let's take a look at some of the market action here. 90 minutes into the trading session, stocks falling today. Increasing geopolitical tension certainly hitting some of the investors' mindsets out there. Joining me now, let's bring in Francisco Bito, who is the FM Investments Senior Vice President and Senior Portfolio Manager. Francisco, great to have you here with us. We're seeing a pullback today, but you're looking out ahead to 2025. Why is that, and what stocks are you watching, even despite some of the geopolitical chop that is playing out today?
Yes. Well, we had a quiet moment there before the election where the geopolitical noise seems to be at a relative minimum, but now it's picking up again. So it's part of the deal. We have to learn how to deal with these things, especially when we have the situation in Ukraine going on. And with the new administration going on and talk about tariffs and so on, then we got to get used to the choppiness. So that's going to be part of life in 2025. And not all necessarily bad. You know, there's a lot of good things there. But I like three companies in particular. I like First Solar, I like AMD, and I like Burlington. And for different reasons. First Solar is super interesting for me because I think the combination of Trump and Elon Musk is good for solar. I think.
Why is that?
Elon Musk is heavily vested in solar, and he is going to have an influential position in the new administration. Not sure what, or in what capacity exactly, but I believe that it's going to basically find that midpoint where it's no longer just about black oil in Trump's mind, but also sharing the energy basket there between solar and green energy. I mean, solar and traditional fuels sources.
Sure. I guess that's one of the picks that is a little bit of a head scratcher because of what we were just showing in the chart in the move post-election and how solar stocks have really reversed course because former President Trump and now President-elect Trump is and has been very vocal about what he would do to clean energy and hadn't exactly been bullish for many investors out there. So First Solar, one of the picks. And then you were mentioning some of the other picks as well, which kind of signals that you may be in a little bit of a stock picker's mentality. Why is that? And what are some of the themes that you expect to really play out?
Actually, I guess you can say that. I don't consider myself a stock picker. What I do is really rely on a two-step process. The first one is purely quantitative. We have our own internal scores here, which we follow, which tracks earnings and revenues acceleration. So that's our primary or the heaviest factor that we look at. So we want to see companies going, even if they're negative earnings, less negative and less negative, we want to see that earnings momentum going on. And, and for that reason, we like AMD. I think AMD is a good buy. It has the right earnings and revenues acceleration, despite the fact that it just took a little bit of a downturn. So I'd say buy the dip with AMD. I think it has a lot of potential in the AI space. And if you look at cloud services, it's expected to grow in the trillions in the next decade. So there's a lot to love there. So I think it's at a good price for the growth that it offers. So AMD is a good pick. So is Burlington Coal Factory. And Burlington, it's in the retail space. And yeah, if you think about it, I'm going a little bit diversified here. I'm poking in all different directions. That is the second part of our process where we put a more discretionary point of view on top of the quantitative layer.
Yeah.
And the reason is because history tends not to repeat itself. It kind of rhymes sometimes, but you need that human in the loop there. So Burlington is firing on all cylinders, and I think it adds a lot of value to consumers to buy off-price retail, especially as the holiday season is coming up. And Burlington is adding stores, it's growing at a healthy clip, it's expanding margins. So what's not to like here? This is a great company, and I think the price is good.
Yeah, you're spot on, Francisco, and really diversified picks that you were, as you were mentioning there a moment ago. as we're thinking about the 50 plus all-time highs that we've seen for the S&P 500 in 2024 and the bull market that continues to extend its run, what are your strategies for investing in a maturing bull market?
Focus on quality. And I know that quality is in the eyes of the beholder, but one sure thing to do, one aspect is to look at a large cap, the larger mega caps. And in an event of a correction, for example, which all markets go through, and that's a healthy thing. I don't say that necessarily as a negative. So when this bull market turns sour, just let it breathe for a little bit. It'll come back. So I would focus on the mega caps. Those tend to bounce up faster because everybody owns them, and more people look at a dip as a possible buying opportunity. So I'll look at that for sure. And also look at the more stable stocks in consumer discretionary, the Amazons, another mega cap, it overlaps with that. And so, and Burlington is in there as well. And the reason for that is that, with rates going down, with the Fed policy sure to continue to ease, I think it's going to be a tailwind on consumer spending, which is already up, and it should be further up in 2025.
And just lastly here, while we have you, Francisco, as you were mentioning, the Fed brings into the equation what your calculus looks like around the Fed's pathway for cuts, and how does that play out and inform your portfolio positioning?
Well, that's a good question. It actually, I let them do their own thing. To be honest with you, what I do is focus on each company from the bottom up and focus on their earnings and revenues acceleration. And that is a great recipe for success long-term. It might, like everything else, it might have a hiccup short-term. But basically, look at the companies that are generating a profit, that are selling a lot of product or services, and focus on that, regardless of what the Fed policy and regardless of where interest rates are at. Just focus on those and, put your money there.
Francisco Beto, who is the FM Investments Senior Vice President and Senior Portfolio Manager. Francisco, thanks for taking the time here today. Now time for some of today's trending tickers. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. First ticker that we're watching here, WMT, Walmart. Yahoo Finance senior reporter Brooke DePalma joins me now here on set. Brooke, Walmart gaining this morning after bumping up its annual outlook here. What are we keeping tabs on?
Yeah, Walmart shares up 4% as the company continues to win with value and convenience, something that consumers are really leaning into these days, the best bang for their buck. We also know that customers are turning to Walmart for those lower prices. And earlier this morning, Yahoo Finance executive editor Brian Sozzi spoke to Walmart's CFO John David Rainey, and he had this to say about what consumers are spending their stretched dollars on.
We're providing value for those customers that are having their dollars stretched further, and we see that they're buying less general merchandise as they're spending more on food.
And food, a big business for Walmart U.S. Groceries make up about 60% of Walmart's U.S. business. And we also know that Walmart continues to win on that rolling back of prices. We know that during this quarter, Walmart cut the cost of 3,000 grocery goods. But it's not just Walmart, Brad. It's also Walmart's membership model business, Sam's Club. We know that Sam's Club, as well as Costco, seem to be winning in this uncertain environment and sweeping up customers. We saw Walmart Sam's Club see same-store sales growth of roughly 7%, almost double what it saw last year. Costco seeing similar results. In the last 9 weeks, those sales were up nearly 5.4%. And as you can see here, these are not cheap. These are premium membership models that consumers are really leaning into because they're willing to splurge on these costs in order to buy in bulk and really get the best bang for their buck in this environment.
Yeah, you got a lot of Members Mark fans out there for Sam's Club and then Costco. I mean, I've even seen Kirkland Golf Clubs enter into
Seems like they have everything, right?
Always in the feed, yeah. So, I mean, are those what's attracting consumers? What's the ultimate play here that's really kind of wooing customers right now?
Yeah, well, it's certainly value, but in addition to that, it's this idea of these private label brands where people feel like they're getting the best price and they're also getting the best quality. And so let's zero in on that private label penetration. Sam's Club has Members Mark, Costco has Kirkland brand. And what we're really seeing here in Walmart Sam's Club, Members Mark grew high single digits. And Walmart executives said that actually outpaces overall segment sales growth. Costco seeing similar results. In the latest quarter, its CFO CFO saying that Kirkland Signature offers significant member value compared to the national brands and continues to grow at a faster pace than our business as a whole. So once again, it's this concept where consumers are splurging on private label. And ultimately, they're making this choice. They're saying, hey, we're going to get the best quality and we're going to get the best price. And that's where we're seeing this really big discretion, this drawing pour. We're seeing people splurge on private label, but we're also seeing people splurge on these premium price products and not necessarily even going in the middle anymore.
Yeah. Brooke, thanks for breaking this down. A huge report from Walmart that we've been tracking and having conversations with some of the executives this morning. I appreciate it. Thanks. Another trending ticker that we're watching here this morning, we've got Lowe's on tap, topping third quarter estimates, raising its outlook. But, yeah, little slippage as the home improvement retailer expects sales to fall from last year. Let's bring in Yahoo Finance housing reporter Danny Romero. She joins me now with more. What are some of the biggest takeaways that you're gathering from this report?
Brad, the story on Lowe's is you got to play the long game here. Sales were down 1.1% in the third quarter. That's less than the 2.7% that Wall Street was expecting. Higher interest rates is dampening the demand and the appetite for the home improvement spending sector. People aren't buying homes and they're putting off expensive, larger projects that require financing. So that limits the visibility going forward. Remember, DIY customers make about 75% of Lowe's business. That's according to their last quarter metrics. But bottom line, it's still unclear when the inflection point will come, especially for the housing market. Executives say that it could happen, particularly for the DIY customer, because they say that homeowners are sitting on $35 trillion of home equity. Yeah. And so they're thinking that that could, within the next year, could boost the demand and the appetite for home improvement spending.
Since you mentioned home equity and the housing market here, we also got some housing data today that crossed the wire. Saw that come through earlier this morning before we went on air. What are we extrapolating from all this data?
Builders are pulling back, and we're seeing that in this October data. Data from the government shows that housing starts fell 3.1% to an annual rate of 1.311 million units. And the biggest drop came from single-family housing starts. That was a shock for me because the previous month in September, it was definitely a gain there. But single-family starts fell 6.9%. And the decline also comes as mortgage rates have been rising. The 30-year fixed loan rate is hovering around 6.7%. So that's really, these elevated rates are dampening the appetite overall in the housing market, and particularly builders. But we did see the National Association of Home Builders report that home builder confidence was high in November. So we could see a slight turnaround.
Yahoo Finance's own Danny Romero breaking down all things housing market, DIY, already own a home, trying to get a home. Yes. She got you covered. Thanks so much, Danny. Headlines will tell you that inflation is moderating in line with economists' forecasts, but even with experts' confidence that inflation is heading in the right direction, prices for everyday goods and services like food and housing remain a pain point for average Americans out there. Here with a closer look at inflation, let's bring in Jeffrey Campbell, University of Notre Dame professor and former senior economist at the Federal Reserve Bank of Chicago. Great to have you here with us. First and foremost, as you think about where inflation is trending towards, are we seeing inflation moderate enough in order for consumers to be able to offset some of the persistent pressures?
Not really, unless the war ends in Ukraine and Russia. The big problem with, and that is the big uncertainty with inflation going on right now, is if that war ends, energy prices are going to come down. That's going to have a big impact on all consumers' spending and pocketbooks. In that case, we're going to have a very nice 2025. If the war doesn't end so soon, I see inflation hovering at around 3%. And those prices of everyday items that people are feeling the pinch on are going to stay high.
What is the direct correlation there? Is it purely energy, or is there something else within the mix?
Well, I think it's mostly a pure energy play. That the energy is a big share of people's budgets, especially lower income people. That is a big spillover into retail as a whole, because of shopping behavior. When people feel a pinch in energy, they go into these trying to find these value propositions at Walmart and TJ Maxx and so on. So they're going to be, if the energy prices pull back, we might see more of a loosening of consumers' wallets for more premium goods and a willingness to take a bit of a higher markup in exchange for more convenience. So that's the only real non-direct effect I see.
And so with that in mind, and the correlation that you're drawing and pointing to here that certainly has been present, what happens when we have, like this morning or like overnight, a ratcheting higher of some of those tensions, and what is the lag effect from the point where some of those tensions ease, or perhaps we do see a cease to, of course, the activity that's played out for the better part of 2 years now? What is the lag effect for that actually lowering and bringing down some of the inflationary pressure?
So putting aside the predictions of geopolitics, I'm no expert on that, but I see most of the potential here is on the upside for the American consumer. If we have a temporary ratcheting up like we did this morning, it might be temporary, I hope, that's going to play out in financial markets, people making bets on the future about how soon things are going to get better. But it's not going to filter down to either the retailer or the consumer just yet. The only time that's going to happen is when there's real action on the ground, and either we have a ceasefire or a peace treaty, or it's clear that that's not happening in the next year.
So what then is the Fed's pathway, and how much does that put the Fed's pathway for continuing to cut rates in jeopardy?
Well, I think what it does is it gives an opportunity to the Fed for what they call opportunistic disinflation. So inflation has been running in the high 2% lately, and Chair Powell has talked about it on a smooth pathway to being at its target, the Fed's target of 2%. The Fed is not promising very much monetary restriction to bring that down, though. They're basically hoping for the best. It's said that it's better to be lucky than good, and they're definitely hoping to be lucky. So I believe that if the peace comes out, the Fed's going to have its job mostly done for it. If it doesn't, then they're going to have to take a hard look in the mirror and see whether they can engineer this soft landing that they hope for so hard.
Jeffrey Campbell, University of Notre Dame professor, thank you so much for taking the time here with us today. Really appreciate the insights.
Thank you.
Coming up, everyone, saving for retirement. There are many vehicles to save. You can use an employer-sponsored 401k, you can use a traditional IRA, or even a Roth IRA. And we're going to talk about which device might be best moving forward as President-elect Trump retakes the Oval Office. Stay tuned. The retirement savings community is abuzz with talk of how a second Trump term will affect taxes and savings potential. President-elect Trump is expected to extend his 2017 tax cuts, meaning the tax bill likely to stay where it is today for the next 4 years. And we're showing on the screen current tax brackets for single filers. Prior to the 2017 tax cuts, that top rate was 39.6%. It fell to 37% under the new provisions and so forth. Our next guest says at some point down the road, taxes will rise, and that will put certain taxable savings accounts at risks. Joining me now on set, we've got Ed Slott, who is the founder and CEO of Ed Slott & Company. Ed, great to see you again, and thanks for joining us.
Great to be back here with you, Brad.
Absolutely. So let's talk about some of the changes that are anticipated versus what's staying the same, and how that impacts retirement accounts. What is kind of the net takeaway?
Well, net takeaway will probably extend those tax cuts for a few more years. That means people have a few more years to take advantage of those low rates. And as you showed, the big brackets. Most people don't realize how much income you can push through historically low tax rates now, 12%, 22%, 24%. People always complain about taxes, but these are the good old days, and you may have a few more years of that.
And so as we're thinking about this, for those who are closest to retirement, what should they be doing differently right now?
Moving more money to Roth IRAs, if they can. Not for everybody. Actually, I think it is for everybody. I'm a big Roth fan because everybody likes tax-free. I never heard a complaint ever from anybody with a Roth IRA. They watch their markets, the markets are up. They watch their wealth go up, and it's all tax-free. They don't have to share with Uncle Sam.
And so what about for newer employees or people who are in a part of that labor force participation number and participation rate that we talk about with the monthly jobs report every month here? How should they be setting their own retirement savings up, knowing that there's a lot more time than those who might be a little bit closer?
Right. I'll probably get a little flack for this because I always do. Stop contributing to 401ks and IRAs. Move instead to Roth 401ks and Roth IRAs. You can build tax-free for the future. And especially younger people. The greatest money-making asset that any individual can possess is time. And young people have more of it to capitalize on it. Why on earth would you bother with a 401k? So some people might say, but Ed, the deduction. That deduction is worthless. It's really just a loan you're taking from the government to be paid back at the absolute worst time in retirement when you'll need the money. Forget the deduction. Think bigger and think about having a tax-free retirement account with a Roth 401k or a Roth IRA.
Now, is there any difference then if you opt for one versus the other on the amount of contributions that you can also have your employee or your employer match?
That is the same. I'm just saying push more of it or all of it is what I'm saying, if possible, to the Roth side. And some people might say, but in the 401k, there's matching. That rule changed. I speak to advisors all the time. Some of them don't know the rules changed. The match can also go into the Roth 401k side, growing income tax-free for life and even 10 years beyond to beneficiaries.
As we think about retirement more broadly, do you think that there is a retirement crisis, and is it something that can be solved even with an incoming administration that is perhaps going to lean on some of the renewal of existing tax programs that they've implemented?
Yes, everybody wants people, every administration wants people to save more for retirement. But you have to want to save. You should take the money off the top. They always say pay yourself first. Put that money in your Roth IRA or Roth 401k, and then live on the rest if you can. Max out this money because this is what you're going to be relying on future retirees, probably more so than Social Security.
And then in addition here, when you are setting up any account, how should you also be investing in tandem to make sure that you're counterbalancing or at least kind of diversifying the way that you are saving for retirement?
Well, you always hope the markets go up, and that's easy to say since markets are up now. And they go down, but they go up, down in an upward fashion over time. So anything that you think will highly appreciate, you want in the Roth because you want all of those gains to be income tax-free.
Ed Slott, great to have you here with us back
Roth.
in studio. Ed Slott, founder and CEO of Ed Slott & Company. Appreciate it.
All right, thanks.
A programming note in this week's episode of Decoding Retirement, host Bob Powell speaks to Investments and Wealth Institute Chief Learning Officer Ross Riskin about the best way to save for college. Ross Riskin says that the best strategy is to use a multi-savings vehicle approach. Take a listen.
What we are fans of, and I'm a big fan of, is a multi-savings vehicle approach, right? I'm not an all or nothing. I'm not put everything into 529 or put everything into a brokerage account or use some other product or solution. You want to have flexibility with where things are going from an education standpoint of maybe what you think you want to plan for higher education. It may change. It may be different there, and you want to use those funds earlier. You want to have flexibility in what you can use to help you reach those goals as maybe the mileposts move around a little bit on some of those goals.
And you can find new episodes of Decoding Retirement every Tuesday, 12 p.m. Eastern Time on Yahoo Finance and wherever you get your podcasts. Coming up, your Yahoo Finance Market Update. We'll check out how stocks are moving and run through 3 stories that you don't want to miss. Stay tuned.
Welcome to Yahoo Finance Sports Report, a unique look at sports business brought to you by Yahoo Finance and Yahoo Sports. I'm your host, Joe Pompliano, and I'll be breaking down the financial side of the game for your financial gain. We'll go beyond the headlines, analyzing all the latest sports news, the teams, the trades, and billion-dollar deals, so you and your portfolio will win big. Catch Yahoo Finance Sports Report on Thursdays on all your favorite podcasts and streaming platforms.
We are 2 hours into the trading day. It is time for Yahoo Finance's market update. Stocks reversing earlier losses, even as investors flock to safety after Ukraine fired U.S.-made missiles into Russia for the first time. The Dow now down about 0.3%. The S&P 500 up about 7 points there, and the Nasdaq up about 0.5 percentage point. 3 trending headlines you need to know at this hour. Shares of Chinese EV maker Xpeng reversing some of the gains earlier in this session here, down nearly 3% despite beating revenue expectations and narrowing its losses in the most recent quarter. Total revenue grew 18% to $1.4 billion, with vehicle sales up more than 12%. The car maker has seen strong momentum from its fully electric sedan launched in August. Xpeng says it sees that continuing, with deliveries in the current quarter expected to triple the growth reported in Q3. That would mark an increase of up to 51% from a year ago. Viking Holdings failing to impress investors despite beating Wall Street estimates on the top and bottom lines. Shares there down nearly 1% right now. The cruise liner's latest quarterly results, the company reported an 11% increase in revenue year on year. Gross margin also increased 18%. The company saying that it has now sold 95% of its passenger capacity for the 2024 season and 70% of its capacity for the 2025 season. And taking a look at shares of C3 AI, seeing a big bump there, up more than 16%. The software company announced it's expanding its partnership with Microsoft's Azure platform. The firm saying that the tech giant will now integrate C3 AI's enterprise AI application software across Microsoft's commercial cloud portal. Shares of C3 AI now up nearly 10% year to date. It is also one of the top trending tickers on Yahoo Finance. That is your Yahoo Finance market update to keep you on track with the news you need to make smart decisions about your investments. For more on what's trending on Yahoo Finance, scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. More wealth when we return.
VA disability compensation, or pay, offers a monthly tax-free payments to veterans who got sick or injured while serving in the military and to veterans whose service made an existing condition worse. According to vetcom.us, 66% of 20 million U.S. veterans have never filed a VA disability compensation claim or were totally denied, and they are collecting $0. My next guest set out to change that. Joining me now on set, we've got Marine Corps veteran Kate Monroe. Kate is the CEO of vetcom.us, publicly traded company that helps veterans receive VA benefits. Kate, great to have you here in studio with us, and thank you for your service as well. Talk to us about your story, how you got to where you are today, starting the business that helps other veterans.
Well, I think getting to where I got to today wouldn't have happened if I didn't go in the Marine Corps. I went into the Marine Corps, a lot of things happened to me that probably shouldn't have. I was assaulted in the Marine Corps. I smashed my nose and eye socket, my elbow, my ankle. But I would get in a time machine and do all that again if it meant I would be right here, right now, talking to you about helping veterans. So I think it gives you a little bit of resiliency. To be an entrepreneur, to start your own business, you need grit, resiliency, drive, determination. And I think I gathered all those things together by having served.
What do you often hear from veterans that are looking to start their own business, and what are the tips that you offer them even in those conversations?
Well, veterans have a totally different path to entrepreneurship or creatorship than everyone else. I mean, you could transition directly out of active duty service in SkillBridge and go work for a company like Vetcom. So if you're active duty watching this, you can come work for me right before you get out. But I always tell people the number one thing you should do is go work in a business similar to the one you want to start, because you may find you don't like it at all, or you may find I'm totally suited to do this. I think you should find a mentor, put together a business plan. But most importantly, it takes a lot of grit, drive, and determination. And I always tell people, start small and build on that. So for instance, I tell a lot of people, if you're in sales, guess what? You can work for me and you technically have your own business because you have your pay plan. You can work as many hours as you want and make money. I would tell veterans, go into the trades, electrician, plumber, contractor, start apprenticeship and work your way up. Over 2 years, you can own one of the biggest businesses in the country.
Your business is critical in helping and making sure that veterans do get their benefits as well. What are some tips for veterans who are sitting, watching, and trying to figure out and realizing, hey, I'm not getting any of my benefits that I am owed at this point? So what are your tips for veterans to help get their benefits?
Well, I think the first tip would be, if you're part of the 66% of people that's never made a claim, right now, when you stop watching me, get on va.gov and file an intent to file. That's you telling the VA, hey, I'm going to make a claim. Then you have a year to decide what you're going to do, but stop doing nothing. That's the first thing. Get out of the trench, start doing something. The next thing is, you might need expert help. You might have tried it on your own. You might be underrated and tried these free services, and you go, I'm sort of at the point I need help, and we would love to help you at vetcom.us. We'd be, like to be there for you, like you're your buddy in this. But the third thing would be, stop thinking that you don't deserve it and that someone deserves it more. This is the number one reason people aren't rated, because some other hero veteran, I let it stop me for 12 years. And so you deliver yourself whole to the service, you come out less than whole, that delta, you are owed that. And it could be up to $3,700 per month tax-free for life.
Wow.
Yeah.
And so as you're thinking about so many veterans being able to get back into the workforce or start their own business, what are some of the top skills that you see in common across veterans because of their experience that is immediately something that transfers into any type of role or job?
Well, I would talk to all the other businesses out there. If you're leery of hiring veterans because you don't really understand what is on their resume, so you go, where do I put them in the mailroom? Do I put them leading an organization? I had a two-star general come and see me this week, and he said that somebody tried to give him like a front desk position, and he was running a battalion. Like, they just didn't understand what they had. Veterans are so resilient, so gritty. They typically have been managing people. Even these young people might have been managing 100 people, might have been managing a massive budget. A lot of these people have already been working on equipment.
Yeah.
There's a great jobs being a mechanic, doing construction, electrical, plumbing. You can make a very good living today.
I think you mentioned something really critical, which is that there is perhaps not an understanding by so many hiring managers, so many businesses. How can, and what are the top questions that businesses and hiring managers should be asking when they do see a application from a veteran come across their desk?
Well, I think the first question the business should be asking themselves is, before they ask a veteran a question, they should be asking themselves, why am I not a SkillBridge provider? Why wouldn't I take the government up on 6 months of free labor, and all I have to do is hire this person when they get out of the service? That means I get to train them on the government's dime. I get 6 months of free labor. We enjoyed this year $200,000 in free labor at vetcom.us, and that helps us with our profit margin, and we hired all of those people on to be employees. So ask yourself that question first. Become a SkillBridge provider. I will show you how to do it. The second thing is when talking to veterans, ask them where they see themselves in your organization. Rather than you trying to shove them somewhere, talk to them about your organization and let them tell you where they think that they fit best. Let them really pitch you their soft skills, their real skills that they have.
Yeah, great insights. Kate Monroe, CEO of vetcom.us. Thank you so much for taking the time.
Thank you so much.
Today. And a programming note for all you viewers out there, Yahoo Finance has teamed up with former Congressman Patrick Murphy and technology executive Dan Coons for Warrior Money. This is a new show dedicated to uplifting the financial well-being of military veterans transitioning to civilian life. Warrior Money airs Fridays at 12:30 p.m. Eastern Time. Well, coming up on the other side of this short break, we're breaking down some of the differences between old money and new money and the financial tips that we all should be stealing from both groups. Stay tuned. If you've spent any time on TikTok in the past few years, you've probably seen one of the millions of videos tagged with some version of old money, whether it's old money style or old money habits. But do they really have the secret to living well? And what can we learn from how the wealthy manage their funds? Joining us now to lift the veil on what really distinguishes old money and new money, we've got Keith Bloomfield, FFT founder and CEO. Great to have you here in studio with us.
Thanks for having me.
Let's talk about this and just kind of start off by defining what really characterizes the difference between old money and new money here.
So I would say old money is multi-generational. So at this point, we would say it's second, third, fourth generation of wealth. New money is first generation wealth creators or second generation. I think that's the distinction.
How do you then make new money old money? Because that's what everybody kind of aspires to.
Time, that's a good question. Time makes it old money, at least in the wealth management business. That's sort of how we describe it. I mean, new money folks are wealth creators, right? And they've made it on their own in their lifetime. Old money folks are really inheritors. So again, third, fourth, fifth generation where trusts are passing money down.
All right, so we got something for everybody here. So first, on the old money front, say that you have inherited or been able to see some type of trust set up so that you can have access to that old money or the wealth generation of prior generations. How do you make sure that you're also stewarding that the correct way, and what are some of the top tips?
Yeah, I mean, that's a great question, and that's with our old money or third, fourth, fifth generation clients, it's really a wealth preservation model. There's not a lot of inflows coming in, so there's not really income coming into the trusts. They're spending it, right? And so we have to figure out a way to preserve it because there's not necessarily new money coming in ever, and also grow it at a way that outpaces inflation so they can live their lives. And I think, the most important thing is really education. They differ so much from wealth creators, their first generation, their great-grandfather, what have you. And they really need to sort of be educated on how to preserve it and grow it. And I think finding the right advisor that is willing to educate is really important.
What are some of the biggest pitfalls that you tend to see in the old money category?
I really think it's just a lack of education, like I said just now, is a perfect segue. I mean, they're really not educated on what it means to make a dollar, how fast it can go, and what it means to not be able to have any inflows.
And so now for the new money bucket, when you are in a hyper growth phase of some of the money generation, how do you then set up strategies to make sure that it becomes generational wealth?
I mean, so most of our clients I would put in the new money category. They're wealth creators, they're dynamic people, they're go-getters, they're competitive, and they also understand the investment landscape generally. And so they flock to our firm really because we specialize in alternatives, whether it's private equity, hedge, venture, real estate, and that's where they understand the returns are going to be over the long term. And by investing in those asset classes, they are able to grow faster than liquid asset classes and will go on much longer. And that's one way to create multi-generational wealth with the wealth you've created in your lifetime.
What is the top asset class that you see a lot of new money gravitating towards?
I mean, private equity is really, private equity and hedge, we think, are really where the puck is going still. Venture was, extremely important over the last 10 years, and we think, while prices are depressed on some private venture funds, we think that's really a place to continue to invest in. Good companies, great ideas, and backing innovators.
As we're thinking about the great wealth transfer that we've talked with many of our guests over the past year about, and the type of wealth that sets to generate for and really kind of diversify out the equity positions and holdings of the broader society as well. The number of women that are going to become wealthier and close the wealth gap as a result of the great wealth transfer. How do you think that will change some of the wealth generation strategies also that people, whether it's old money or new money, are really going to tap into?
Well, I think people really are focused on educating the next generation. And 100 years ago, when you made a tremendous amount of wealth, you didn't really include the family and how much money there was, where was it going. It was just a different time. I think today where we are is the amount of communication, of course, with social media and what have you, is incredible. And I think families understand it's important to educate the next generation, explain to them that if you have multi-billion-dollar family, there's a lot of responsibility that goes with that wealth, both to manage it properly, do good with it if that's what you're looking to do, and also preserve it for the generations to come. So I think communication, education is becoming an important part of our business because people want their wealth to last multi-generations.
Keith Bloomfield, who is the FFT founder and CEO. Thanks so much for taking the time.
Thanks for having me.
Absolutely. Well, if you're looking for ways to start making some new money, our next guest has 7 daily habits that you can implement into your life to help you generate more money, time, energy, and happiness. Joining me now, let's bring in Rachel Rogers. She's the founder of Hello 7 and the author of the book, $1 Million Action. You lay out 7 daily actions to take, but I want to hone in on a couple here. Number 4, particularly, is to do one money-generating activity daily. Give us an example of what this could look like.
Yes, that was so interesting listening to the old money conversation versus new money, which is what I am, right? And so he was saying old money doesn't really know how to generate income, well, new money, that's where it's at. That's what we do, right? That's our skill set. So taking action to generate money every single day. That means coming up with either a side hustle. Do you know that most workers today, over 50% of people working 9 to 5s have a side hustle, right? And so coming up with a side hustle to make some extra side cash can be as simple as dog sitting, house sitting, babysitting, hosting a yard sale, coming up with an offer, doing a workshop, teaching something that you are skilled at. These are different things that you can do to generate additional income. So that's one thing that you want to think about. And then really paying attention to your money as well. You've got to be focused on your dollars, right? And so that means knowing what's in your 401k, knowing how much you're bringing in, knowing what the gap is between where you want to be and where you're at, and then making sure that you're using side hustles and negotiating higher pay, doing yard sales, buy old furniture, fix it up, sell it, right? These are all things that you can do. And then, of course, make sure you're getting your reimbursements from your employer. If your cousin owes you money, go ask for it, right? We have to pay attention to our money and all the places that it is and call those dollars back in, and then make sure that we are closing that gap that we have where we want to earn more and our paycheck doesn't get us there. You still have skills, right? You still have skills and ability to generate more. And that's our power as new money.
You know, in these 7 daily actions, number 6, I want to go to that one. Look at your money every day. How can someone do that without feeling overwhelmed or stressed?
Yes. Well, what's going to make you feel less overwhelmed and stressed is making this a habit. Peter Drucker said, what gets measured gets managed. And I live by that. So I make sure I pay attention to my money and I'm looking at it. I'm measuring it. I'm seeing where is it going. I don't want $1 leaving my bank account for things I don't care about, right? I want to make sure every dollar is going towards something that makes my life better, right? That enhances my life in some way. So you've got to pay attention to your money. A lot of us, when we feel not empowered around money, we put our head in the sand. And that is the opposite of what you want to do. The more you focus on it, the more attention you give it, the more opportunity you're going to see that you have to generate more of it.
While we have you, today is Women's Entrepreneurship Day, honoring female entrepreneurs. I want to know, what advice would you give young women who are looking to start their own businesses?
Yes. The advice that I would give is that you have all the talents and skills that you need within you. I know it sounds hokey, but literally this is how I became new money, right? This is how I went from growing up low income to having money. Is I really just did an assessment to say, what skills do I have? So doing some personality assessments like Colby, Strength Finders, DISC, figure out what you're good at, what your skill set is, right? And then figure out how you can package that into a service or product that you can deliver, right? Come up with an offer that you can sell. Like, I'm good at public speaking, so I can sell a workshop or a training or a seminar or being on stage, right? Those are some of the things that I can do. So you come up with an offer and then announce that offer to your network. A lot of times we think, well, I don't have 100,000 followers on Instagram. You don't need them, right? You already have people who know, like you, and trust you. When I started my business, I simply announced it to 100 people that knew me. They were my neighbors, old coworkers, old classmates, old professors, right? Just people in my life. And from those 100 people, I got my first 3 clients. And then from those 3 clients, that's how the ball got rolling, where I got more and more referrals. And here I am today running an 8-figure business. So it starts off slow, but it can grow really quickly. So start with that self-assessment and really understand what your natural talents are, how you like to work, what experience you have, and package that into an offer.
founder of Hello7, Rachel Rogers. Continued success to you, and thank you so much for taking the time here with us on Yahoo Finance.
Thank you for having me.
Certainly. Let's do a final check of the markets with the time that we have left. Taking a look at the NASDAQ, the Dow Jones Industrial Average, and the S&P 500. The S&P 500 and the NASDAQ still in positive territory, fractional gains there. However, the Dow, we're still seeing that in negative territory right now. We're down by about 0.3%. Markets being rattled today. Early in trade, we saw that show up in the tape down, but ultimately seeing a little bit of a reversal. Thanks so much for watching Wealth today. I'm Brad Smith. Guess what? You can stay tuned. Market Domination with Julie Hyman and Josh Lipton. That comes up 3 p.m. Eastern Time. You don't want to miss it.